Okay, ready? Good morning, everyone, and welcome to our presentation today. Which tax act is it? My name is Leonard Andis. I'm the president of the Independent Association of Accountants, and today we're going to have Doreen and Inserra and Brian Gordon presenting to you. Doreen will do a lot on as usual, on the federal tax issues, dealing with tax acts and the various changes and what's coming up for the next season, and a little bit of what probably has been proposed and what we think at this point might go through. Brian will follow up on some state issues. We'll talk about the COVID issues and the domicile issues, and in particular, which states people are going to be working out of and living out of, and how they're going to be reporting some taxes this year. Everybody's in the first things off, I want to thank John Amodio and Marie Grassi and Bart and everyone over at SCORE for all the help they give us and for allowing us to work with them the last 5 years in doing this presentation. It's become an annual thing, and it's, I think, a really good one. Unfortunately, we can't do it in person this year, but we're going to hope for next year. Also want to thank Richmond County Savings Bank for sponsoring us today. They helped defray some of the issues and things we have to deal with and cost. Handouts should have been sent to everybody prior to the meeting. Hopefully you have them all. If you did not get them, there were 2 handouts, one for Doreen's portion, one for Brian's. Okay, let us know. We'll try and get you one during the meeting, if not for sure after the meeting. We're going to be using keywords today. All right, so at various times during the presentations, you're going to get a keyword. Please write them down. They have to be submitted with your evaluations. All right. And they're going to be 7 of them. You have to submit 6 of them. All right. Try and write them down, because the object is to make sure you're paying attention. Okay. And it's state and AICPA and IRS requirements that we do that. You also have to be on the webinar for 150 minutes out of the 3 hours to get the full credit. If for some reason you're only on for 110, okay, you'll get 2 credits only. Again, we have time tracking on this, and we're only doing it to meet the requirements of the state and the IRS. Certificates and evaluations. Evaluations will be mailed out by SCORE after the meeting. Okay, please return them. Make sure they're signed. Include the keywords, as I said before. All right. Electronic signatures are acceptable. So if you're filling them out electronically, you don't have to print them and rescan them and whatever. And then certificates will follow. I believe SCORE will be sending a certificate, and anybody that's getting credit will get the appropriate certificate, either for the CPAs or for the IRS CE credits. We're awarding 3 credits for both CPE and CE today. I believe, and Doreen, correct me if I'm wrong on this, we're going to take a 5-minute break around the top of each hour.
John had suggested that I do my presentation and then go into the Q&A, and then we take the break at that time. He'd rather do 1 break and then go into Brian's this time.
Okay, that works. All right. Just so anybody wants to know, for the IAA, I'll post it in the chat afterwards. My contact information is 718-948-3008 or LIA Ranger, RANGER @AOL.com. Questions and answers, we're going to take them as we go along the best we can. Post them in the chat or in the Q&A, and we'll try and keep up with them as quick as possible. If we're running a little crunch, we might save some for the end. Just for the IAA and anybody that's interested, we are ordering tax books again. I've got most of your orders, but if in doubt, just get with me in the next day or 2 so I can put the order in. All right.
Lenny, I
Yes.
got one message from Frank DCPA, said he did not get the handouts. So
Okay, we'll forward him one shortly. Frank will send you one soon. And lastly, for the IAA, and of course, anybody else that's on here that's interested, we're gonna be doing one more presentation this year. Unfortunately, I couldn't get anybody to do the ethics. If anybody still needs ethics credits, please get in touch with me and we'll get you on to something. And our last presentation will be on January 20th. Warren Bergstein and Jack Gold will be doing their annual update for us. All right. And by that time, hopefully we'll have a tax law and everything will be included so we can go forward. All right. Anyway, you've heard enough of me. I think you want to hear a lot more Doreen and Brian because they're going to give you a lot more info than I am. So welcome, everybody. Thanks for joining us today. And Doreen, it's all yours.
thank you, Lenny. Thank you, John. John, I wanted to give John one more opportunity if you would like to say anything, but we can't hear him today. He's not coming through.
Unfortunately.
Thank you. But I want to thank SCORE for having this presentation. I believe it's the last 20 years. We might be going in the 21st year. And also, as Lenny said, the IAA of Staten Island has been working with SCORE of Staten Island in providing this presentation for CPE and CE for the practitioners. So I try to cover all the information I can. And let's just see, it kind of popped off here. There we go. Waiting too long to do the presentation. We're going to cover, believe it or not, 11 tax acts within the hour and a half. Now I'm going to have some poll questions. That's just for you to put in interactive to see if you're listening. We are going to have keywords. I'm going to say the keyword. If for some reason I missed the keyword, Lenny will remind us. But we're going from 2017 with the Tax Cuts and Jobs Act all the way up to a newly passed bill, which is in November, in the Infrastructure Investment and Jobs Act. So we have a lot to cover. This slide 3, if you're following us in the handout, just shows 1 year's worth of revisions to tax acts during the pandemic and into 2021. And believe it or not, I've got this information in, so there's a lot of information here. We're going to go from the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act, which was issued 14 days after the shutdown. Found that interesting. All the way to the Infrastructure Act. So in this presentation, I'm working kind of a little bit backwards. I'm doing the more current act to encompass the changes that we need to know about. And that was the Consolidated Appropriations Act of 2021, known as CAA. And it was signed into law December 27, 2020 by President Trump at the time. It has over 2,000 pages and 32 divisions. In our presentation here, we're going to cover Division N and Division EE. The reason why I picked this is because the Taxpayer Certainty and Disaster Tax Relief Act of 2020 brings in extenders that you need to be aware of for 2021 in the 22 tax season, as well as the economic aid to hard-hit small businesses, nonprofits, and Venues Act. I don't know if many of you heard of it, but it's called the Economic Aid Act. And so if you need more information on it, in the handouts, I have hyperlinks in the PDFs. You could go right to the resource. So in the CAA, again, passed at the end of December 2020, it made permanent the medical expense deduction threshold, which is now 7.5%. Now you would have said, I thought that's what it was, but it was actually going back and forth between 10% threshold and 7.5. That has now become permanent. In addition, the qualified tuition and related expense deduction has been repealed as above the line deduction when you're looking at your educational deductions and credits. And they now have in the increased phased out levels for the lifetime learning credit. So that means AGIs of married filing jointly of about 160,000 can still take the American Opportunity Credit, which is $2,500, and married filing separate singles and other filers can
Hold on one
also
second.
take the lifetime learning credit at $80,000. Now, the lifetime learning credit is a one-time credit per year. That's up to $2,000, and the American Opportunity Credit is up to $2,500. And you know, as practitioners, you have to do your due diligence when you're applying those credits. What else came about? Temporarily, in 2021 and 2022, we have a temporary 100% deduction for meals, okay? Just for meals, not entertainment, because as you recall, the Tax Cuts and Jobs Act took out the entertainment expense, and you have to enter that on a separate schedule on your return as a non-deductible expense. The Tax Cuts and Jobs Act in 2017 allowed 50% of meals. Those are business meals. What I want you to take away from this presentation and this slide is, you see how they give it to you in 2021 and 2022, 100%. In 2023, you're going to start seeing some correspondence audits. And that means you need to have good record keeping, right? We have to hit 5 criteria that they're going to look at. Is it a business expense? Make sure it's not luxurious or lavish, right? Record on the receipt. Who was in attendance? Is it the officer of the company, of the business? Is an employee of the business? What customer was there? Okay. And also, as we said, you have to have good record keeping in your books and records for this. But yes, 100%. And that is for prepared meals, not prepackaged meals, Okay, at bottom of this slide, I'm kind of going to go into the next slide because that talks about the economic impact payment on the bottom. Yes, we had 3 economic impact payments. One was at the beginning of 2020 during tax time, April of 2020, which was under the CARES Act. Then the Appropriations Act brought the second economic impact payments, which you see on the bottom here. That was Division N, COVID Tax Relief Act of 2020, brought in the $600 each under Section 6428. Not going to cover these in detail because we reconciled these on the 2020 return under what is called a recovery rebate credit. And that is why IRS still had 11 million returns that they didn't finish processing, including unemployment compensation exemptions, because there were errors, mathematical errors, as they're calling them, on the calculation of the credit. So you have another chance in 2021 where you're going to have the third economic impact payment. If you recall, we received $1,400 under the American Rescue Plan Act, and you're going to be required to reconcile that credit on the 2021 return. And there's a form that the IRS is going to be sending out. We're going to talk about that in a little while. Now, the flexible spending accounts under the Appropriations Act. I don't know how many people do have that, but if you do have that at work, now is the time to start getting your reimbursements through healthcare, through your medical expenses, submitting your invoices, or if you're running it as a small business, you have 2.5 month grace period for qualified expenses to use that. And the plan may have a $550 carryover, but it has to be written in the plan. So now's the time to look at that. There was a change via the Appropriations Act, which allowed mid-year changes. And this very busy slide, what basically it says on slide number 9 on your handout, is the flexible spending account is now a little more flexible under the Appropriations Act. The reason being is that $550 amount might be a little bit higher that they're allowed because of the pandemic. So you need to look at your plan. You need to talk to your HR and find out how much can be carried over, because you don't want to, if you don't use it, you lose it. Also, when these provisions came out, the businesses, the employers needed to adopt. And as accountants, if we're doing small businesses and they have flexible spending accounts, we didn't tell them that you have to adopt. They can't take these provisions, these more flexible provisions. And that's why we want to bring that out to you before it expires. In addition, under the Taxpayer Certainty and Disaster Tax Relief Act of 2020, the law extended many energy-related credits through December 31st, 2021. So you know, when you're sitting with your client, they'll be asking you, can I get a residential energy credit on my primary residence? And certain of these have been extended. And on this next slide, you'll see the ones that are. So we have Section 25C, a 10% credit for qualified non-business energy property. Section 30B, a credit for fuel cell vehicles, credit for alternative fuel vehicle refueling property credit. Section 45L, energy efficient homes credit. Section 168E3A, your mortgage insurance premiums. So they are permitted to deduct their mortgage insurance premiums, which as accountants, we tell them try to minimize those, which means that you got to pay more of your principal so that you don't get charged a premium. But if they do, they are permitted to write it off based on a certain threshold of their return on their Schedule A. And that has been extended to 2021, and that's only for the qualified residents to 2025. From 2021, it went to 2025. So it's going to be extended there. So they need to look at their Form 1098, which is going to come from the mortgage company, which is going to be a lot more detailed. It's going to show the interest paid. It's going to show when the loan originated. It's going to show what property it covers, so to determine if it's qualified residence. And then, of course, it's going to show the mortgage insurance premiums. And then Section 35, health coverage tax credit. All right, slide 12, again, still a continuation of the Taxpayer Certainty and Disaster Tax Relief Act of 2020. So going back to your education credits, there is an increase, as we said, in the maximum AGI. I told you before, 160,000 married filing joint and 180,000 for your singles. And they put together these credits and repealed the qualified tuition deduction. All right. In addition, we also have increase in our charitable contributions, and we'll go into that a little bit more. That's in the middle of this slide. Bullet 4 down, mortgage forgiveness debt relief, that has been reduced from $2 million down to $750,000. So there's a form that goes with your return when you get debt relief on a mortgage to hopefully get excluded from being charged income tax on it. That's a Form 982. However, the threshold went down to $750,000, which will apply to 2025, okay, from $2 million. So you have to be aware it went down to 2025. In addition, we will find that we talked about the energy credits and also the minimum age for retirement distributions. I find this very interesting. In addition to the Secure Act of 2019, which changed the 70.5 age on required minimum distributions to 72, quarter down to the slide, you'll see for certain construction and building trade workers, they are able to retire at a lower age, 55, and not have a penalty. Otherwise, it's 59.5 when you're going in from your retirement plans. Now, what about charitable contributions? You'll see in this slide that we now have a new standard deduction. You probably experienced it on your 2020 returns or when you were preparing these individual returns, where there was a maximum of $300 charitable contribution if you are a standard itemizer. And believe it or not, standard itemizers are 9 out of 10 these days. You know, a lot of the miscellaneous expenses have now been removed, so we mostly have standard, not itemizers, but standard deduction takers, 9 out of 10. And they allowed you to add the $300 in 2020, and now that's increased to $600 for married couples, okay? Now, the allowance for 2021 applies to cash contributions to most public charities. It doesn't include supporting organizations and donor advised funds. In addition, you need to not only have, you know, your proof of your payment, but you have to have an acknowledgement letter from the charity as well. And it extended it into 2021 elective suspension of certain limits on contributing on the individual level. So for example, we have up to 100% of AGI that you can deduct without having to do a carryover for charitable contributions. That's if you itemize, okay? This slide here, 13, is only if you are a standard filer. Okay. In addition, in the CAA, we have permanency of presidentially declared disaster zones. So if you remember Hurricane Ida, there's an extension on filing those returns into January that were on a formal extension in October, right? They were allowed, if they were in that presidentially declared disaster area, to have an extension to January. This is now a permanent provision. So when a presidentially declared disaster area is zoned out, that the IRS is able to extend those thresholds. So you should always look at that when you have those cases. And also what's called qualified disaster distributions, up to 100,000. Okay, we know that we had that in the COVID. We're going to go over that. But now that has become a permanent provision that they can go to when there are casualties, Now, the Infrastructure Investment and Jobs Act of 2021, which was passed on November 15th of 2021, is what made these extended filing deadlines for presidentially declared disaster zones permanent. Okay, so, and that's where you get that QDD wording, okay? Now for COVID-19, that was covered under the Appropriations Act, if you recall what I said earlier, signed into law December of 2020, and then the CARES Act. So there was a CARES Act that started it 14 days after the pandemic, and then you had an extension in the Appropriations Act. And what the COVID-19 related distributions are your coronavirus related distributions. These are from your retirement accounts, such as your 401ks, your 403bs, your 457s, your IRAs, where you, the client or the taxpayer, individuals, were able to take a distribution up to 100,000, what's called as a qualified disaster distribution generally. In this case, it was a CRD, coronavirus related distribution, in 2020. And if proved it was related to the coronavirus, then they were able to average out a third of their distribution, so they wouldn't be hit with 1 year, take the federal withholding on it and apply it and carry it over to those next years as they needed it. And then by the third year, if they were able to then not use the funds, if they didn't need it, they're able to pay it back, they can give it back to a retirement plan before the end of the third year, which would be, we had 2020, 21, and then 22. They gave it back in 22, then they would able to amend their 21, their 20 returns, get the federal withholding back, not put it on their 23 returns. So this was due to the pandemic. And of course, it expired. That was as of end of 2020, because that was where the coronavirus related distributions were suspended. And then you had your regular disaster distributions, which had to do with, like, for example, your Hurricane Ida. All right, so don't forget to put those coronavirus related distributions on the third that's due on your return if the client then had that in 2020, going into 21 and then 22. And as you can see from this presentation, this slide here on slide 16, there are many notices that were issued by the IRS and published on this area. You see the first year is 2020. That means that's the year it was published in. 2020-50, guidance for coronavirus related distributions and loans from retirement plans, right? It was a very complex area and people were getting confused. But what people didn't realize is for the employers, as there were employers who were leaving their jobs during the pandemic and maybe going on unemployment, there could be partial plan termination. And so the provisions also allowed relief for that. for the employers, okay? So they allowed to have up to a 20% fall off from the plan without having to terminate the plan. However, again, the employer needed to adopt it. They needed to adopt that provision in their plan. Otherwise, they couldn't practice it when they were preparing their employee benefit forms. So the CAA includes relief provisions that allows a plan to avoid a partial termination. And that went from March 13, 2020 to the ending of March 31st, 2021, okay? And that allowed for them having at least 80% of the active participants in the plan, okay? And that was very important to note, because when we get later on into the employee retention credit for businesses, they needed to bring back the employees so the plan could get unstable. And so that's why that provision was put in place. All right, so.
Doreen,
Yes.
let me interrupt 1 second. I got a question from Larry.
Okay.
If a tax preparer is in a disaster area, but the client's address is not in the disaster area, AKA Hurricane Ida, does the client still get the extended date for filing?
I believe it has to be the taxpayer, but there is a provision for the practitioner, right, to put in a request to the IRS with regards to that taxpayer. I don't think the taxpayer can necessarily put that on their return, but I will get that information directly for them after the presentation.
My question to that is, how is that marked on the return that you're taking the hurricane on an electronically filed return? You got to put a separate page in there with a note?
So what happened is that right now we're in the paper filing season, because the IRS is going to soon shut down. The business shutdown, I believe, is the 23rd. And the IRS's shutdown was at the end of November 20th, I believe. So, and there's an extension to January, right, for these returns.
Right.
So you can actually send a paper return, which you would mark that on top under the disaster that you're filing for, and making sure that you're in that area. But when you electronically file in January, if you want to wait till then, right, if you can, because their program may not be opened up. And I talked to a revenue agent about that. What if it's past the date? And they said, well, if the client is expected a refund, then they could wait for the electronic filing. If they owe, they should send it in before the date and mark it on their return. But the electronic filing will probably have a box for you to click if it has to do with,
off.
Yeah, for that disaster.
Okay. And while we're in the area, will 2021 withdrawal qualify for 3-year spread to income?
No, that's just for 2020.
Okay, and I'm not sure what this one meant. Somebody
I
will have to
believe this
clarify.
QDD is just for 10% penalty. You don't get the 10% penalty.
Right. And then somebody said something, I'll have to clarify this because I don't know who asked this. From an IRA in New York City area for Ida. I'm
Yeah,
not sure what they mean by that.
there are
Okay.
areas in New York City. There are areas in Staten Island that were, there were areas in Westchester. You just have to
okay.
go into irs.gov for that.
And yeah, as
Oh,
I got
and
it.
also irs.gov/disaster assistance.
Okay, and as I got it, the New York City include the 5 boroughs for Ida.
But that would have to be checked there. You just put your zip code in.
Yep.
Okay.
Okay,
Alrighty.
go ahead.
Good questions. Good questions.
Thank you.
Okay. Now we get into the pandemic on this slide, because I'm kind of bringing you back from the CAA, what the CAA affected. And we had PPP loan forgiveness, right? Because we had PPP loans, and that's a whole presentation in itself. SCORE was good enough to do that presentation with me in July. And we brought that out to the small businesses and individuals that were affected. The CAA provided that gross income does not include the forgiveness amounts. So that's a big issue, because when you're applying for these other types of grants, they didn't include PPP loan forgiveness as income. And also on your tax returns, we'll see later. In addition, the economic injury disaster loans, which is EIDL, right? Where you would prove a substantial injury, which means when you look at your assets versus your liabilities, you're going to have a negative in that equation and you have an impact. You would be eligible for an EIDL. Also, EIDL funds, of course, are not included as far as income taxable or any of these other funds, because that's a loan, but any of these other funds, when you're calculating EIDL, will not be included as well. It's just you can't use each of these funds for the same expenses. And that's really the bottom line here. There was also something called the Restaurant Revitalization Fund. We have that on a separate slide, and a Small Business Bankruptcy Reorganization Act that came into play. And we also did that with SCORE in September to help the small businesses as well. So this is federal. Remember, Brian later is going to talk about state and local issues with regards to residency and telecommuting. So a lot of these provisions, you have to remember, I'm talking is federal, and then you have to go to your state and local jurisdictions to find out how it impacts there. All right, what other important changes were there? As we said, there was educational assistance changes. We talked about some before. This slide number 19, talks about when an employer is permitted to give an employee up to $5,250, which is an annual limit that has not been indexed for inflation, and it can be used to pay student loan, okay? It can be used to pay a qualified education loan and also current tuition, right? Without being taxable to the employee. This has been extended through December 31st, 2025, right? And then the American Rescue Plan Act of 2021 extended student loan forgiveness to January 31st, 2022. And I had a client call me the other day, and they said that they had gotten forgiven, and they actually applied 4 years ago. However, due to all the pandemic and all this legislation, they finally got approved. So they were happy about that they had loan forgiveness. They were in the healthcare industry, but then all of a sudden in the mail, they received 38 $1,000 checks back from the IRS or Treasury. And they called me and said, is this taxable? And essentially what happened was, because it took so long for them to get forgiven, it was retroactive, all right? And they returned their principal payments to them. So it wasn't taxable. So they, in essence, received $38,000 just a few weeks ago due to the forgiveness. So it is working somewhat. It is expediting this for the educational arena. This slide is just to let you know that during the pandemic, slide 20, that there was the Families First Coronavirus Response Act, which was known as FFCRA, and it brought the Family and Medical Leave Act benefit, EFLMA, and the new Emergency Paid Sick Leave Act, PSLA, okay? And these are, I'm giving you some interpretations by law firms because they also help, I provide you a link into that. These were till March 31st, 2021, and then there was some extension during the 2021 tax season during the CAA. And the one that I provide you in the middle is the Employer Paid Family Leave, Medical Leave Act Subsidy, okay, which takes, in addition to these other two that I provided to you, under the Internal Revenue Code. It has made it available since 18, but they extended it, and it's a credit, so we like credits, dollar for dollar, and it's 12.5% of eligible wages if on the paid leave is at least 50% of wages. So the paid leave has to be at least 50% of wages in that case, and then it increases up to 25% if the paid leave benefit, the paid leave wages is equal to 100% of wages, okay? So that's another credit that's out there that you have to be aware of. And you go back when you're in 2021 and you look back at 2020, and then you see what was paid out as wages. In this case, in this example here, the 70 to 8,000 paid in 2020, and you would apply your credits, determining whether it's at least 50% of wages or 100% of wages, okay? And so the CAA extends the credit through the end of 2025. So something to look at for your small businesses and your employers. So yes, there was this extension, and there was the removal of mandatory provisions that employers pay for no work performed. What does that mean? Well, we can now add healthcare expenses and retirement contributions as an employer to our wage calculations, even though the employee was not working, to get the benefit of these extended employer credits. Okay, we're going to go over the employee retention credit, but you should be aware of that very niche provisions there as well. Okay, and the American Rescue Plan Act allowed us to continue assistance to unemployed workers as well while we were applying these credits to September 6th of 2021. And not all states followed that date, but employers were combating trying to get employees back. And then since they couldn't sometimes, they were able to get credits based on paying their healthcare costs as well as their retirement contributions, okay, that we're doing. So, okay, we're at slide 22, and this is a poll question, but a poll question for you to interact with the presentation. You could put it into the chat. It's not the poll question for the continuing ed, right? We're going to give you a keyword for that in a minute. So the question is, can someone claim a tax credit for sick and family leave wages paid in August of 2021? Yes or no? Let me see if you are listening in the chat. If Lenny is around, he could take a look to see what people are answering. And I'm looking as well, and I'm seeing yes, yes. Some people are saying no.
I'm seeing a mixture.
Yes. And the answer is yes in this case. The answer is yes in this case, okay? So that's under the American Rescue Plan Act. So with that, Lenny, I'm going to do my first keyword for those that are here for CPE and CE. And this is 1 out of what, 7?
1 out of 7, you got to answer 6 at least.
Okay. The first one is easy. It's tax. Tax. You actually see it in this question, the word tax. So I'll give you a few seconds to jot it down, and then we'll go to the next slide.
Okay, please make sure you write them down.
All right, you need that. You need that for your CPE and CE.
Right. Doreen, I had 2 questions before you go on.
Okay.
Frank's asking, how about the latest New York State Governor Cuomo grants? I believe they are not taxable, he's saying.
Again, I'm not covering New York State.
Yeah, okay.
Right. So
yes,
we can ask Brian that. And if he doesn't know, then we'll jot down that question and we'll get Frank the answer.
We'll get back on that. And then Cynthia asked, is someone an individual or a business?
For what? For which?
Not sure, because I kind of wandered there for a minute or two. Does that relate to what you just did?
I don't know what she's referring to. If you could ask her to make that a little bit more detailed.
Last question, she said.
Last question. This question?
Yeah, I guess that question, yes.
This is for business. The sick and family leave wages. So if she's an individual, then it would be her employer. If they're their business owner, then it would be for their employee. If she's a business owner. Okay. Alrighty. All right, let's go to 23, and she could chat to you, Lenny, and expand on it.
Yeah, no, that answered it. that was good. Thank
That
you.
was what she needed. Okay.
Yep.
So let's see if I can move this up here. All right. So we have, as we said, paid and family leave expansion. We covered that. We went over that answer. And you could actually read slide 23 to get more information on that question, that poll question I gave you. So let's go to slide 24. The business tax provisions and business disaster tax relief. And I'm really going to focus on the employee retention credit, but there was a lot of provisions in there. I think people have a lot of questions with the employee retention credit. However, before I do, I want to bring up to you, and I want to make sure you know about some of the year-end tax moves that you should be either telling your clients as businesses or as businesses yourself implementing. So we know today is the 11th. We have a few weeks till the end of the year. And we have what's called an investment in our business for equipment. And we may want to consider, under the Tax Cuts and Jobs Act of 2017, what's called a Section 179 expense. And what we would like to do with that is determine whether our business needs equipment, and then also determine, when we do purchase this equipment, how are we putting it in place? Are we putting it in first year expense and getting a deduction for it in the 21 tax year? Or are we going to do it through bonus depreciation and get a portion of it, 100% of it actually comes into play? It used to be 50%, but the Tax Cuts and Jobs Act made a very generous limit, 1.05 million, as you could see here from the slide. Now, of course, if you didn't make that much, you can't invest that much. And the thing is, you can only invest into up to how much net income you have, all right? And that's for the new equipment, right? You can't get a loss from it. But for bonus depreciation, you can. So you may want to consider bonus. Now, the only thing I am going to say about state and local here is many times the state will add back the bonus depreciation. So you need to do a calculation of that to see whether it's worth it on the state side. And for bonus depreciation, you can use qualified new or used property, all right? That was a provision that was added. Now, when you say used, what do you mean, Doreen? Why used? Well, used to another person is new to you, and they could put it into place, okay? If it's put into place and it's serviced and used, you can take that bonus depreciation. So that's bullet number one, something you really need to think about, communicate to your businesses and for your own practices. And the small businesses that are on this Zoom. There's also special bonus depreciation still from the Tax Cuts and Jobs Act on luxury autos. And that's for new or used passenger auto with a gross vehicle weight rating of 6,000 pounds or less. And with that, you could take 100% business use, of course, it's based on percentage, up to 18,200. And that includes 8,000 of first year bonus depreciation, all right? So that is still available and you still have time. And when you compared this to prior to the Tax Cuts and Jobs Act, it was only $3,160 that you were allowed to depreciate. So it is something that you need to take advantage of and you want to make sure you do when it's still available. In addition, under the Tax Cuts and Jobs Act, the listed property, computers, and peripheral equipment was removed from the listed property fixed asset categories. What does that mean? It means that you are allowed to purchase these items like a laptop, a tablet, a printer for business use and expense them right away under other deductions without having to list them and without having to inventory their use. However, that does not excuse you when you buy equipment for your business to inventory your property's use for cybersecurity purposes, okay? So that's very important because if there's practitioners on the call, later I have a few slides and I always remind you because it's the end of the year and we're renewing your PTINs, you have to click, I have a written security plan. And one day you may be asked to upload your written security plan in your PTIN portal. So it's good to know about this. You still need to inventory equipment use for cybersecurity purposes, but you don't need to inventory equipment use for write-off purposes under the computers and peripheral equipment category, because that is no longer available. And you shouldn't have that on your depreciation schedules. Okay. And of course, there was something also that in the Tax Cuts and Jobs Act, when you fell below a 50% use previously, it was substantially affected. The Tax Cuts and Jobs Act eliminated that obstacle, all right, and allowed you to take the expense. Okay, and we don't know how long that Tax Cuts and Jobs Act is going to stay in place with the Build Back Better bill kind of teetering, but we're going to go through a few slides at the end. The Work Opportunity Tax Credit, you see this a lot, WOTC. I don't know if many people have utilized it, but it's available, and it's available to 2025. How do you take this credit? Well, first, you have to hire and pay eligible workers, right? And these new hires have to begin to work by December 31st, 2025. What does that mean? Because each year the credit is extended. So if you hire them before the December 31st date, you may be able to allocate some of the credit. All right, what is this eligible worker area? And I only list a few of them here. Of course, the list is long and you could go to irs.gov, but it's qualified ex-felons, designated community residents, vocational rehab referrals, qualified summer youth employees, qualified SSI recipients, you know, they have very limited resources, long-term care assistance recipients, and qualified long-term unemployment recipients. And we have a lot of that. So this is a credit that you are able to utilize, especially today with a large amount of population that are in long unemployment cycles. And the WOTC generally equals 40% of the qualified first year wages paid to an eligible employee. So, and that's up to a maximum amount of $6,000. And this translates into a maximum credit, dollar for dollar, $2,400 per eligible employee. As you see, 40% of $6,000. There's a higher limit if you hire qualified veterans who's entitled to compensation for a service connected with a disability and who was discharged or released from the military within the last year. And that maximum credit is $4,800 per eligible employee, or 40% times $12,000. Now, of course, that's if you paid that maximum wage during that period. Now, where do you report this? You calculate and claim the credit on Form 5884, Work Opportunity Credit. And it's subject to limitations. Well, you may have other credits from other businesses. So it all gets summarized under Form 3800, which is your general business credits. And if you have credits that you can't use, you can still carry over for 20 years, these credits. So it's something really to research about, and then we kind of don't emphasize as much on. And especially coming out of a pandemic, it might be something good for you as an employer or practitioner to recommend. Other expanded paycheck protection programs we talked about. These are other provisions that came out of the CAA. We know that unemployment was extended, so we're going to have planning for that in 2021, and relief for renters, right? We had that as part of these provisions. Those are less tax related, but I thought you should know about them. And then, of course, as we come into the EIDL for COVID-19 or the economic injury disaster loan, a lot of these loans now are going into their loan period, which is 30 years, okay? So basically, the business who took an EIDL loan is in kind of a partnership, I'm gonna say, with the SBA, because any changes that you make to your business, you sort of need to get approval from the SBA, right? Because you have a loan, and generally it's going to be a personal loan against and collateralized against your business, right? Officers had to certify that as well. So you could prepay this, there's no prepayment penalty, but you need to be aware that there is a loan, the EIDL is available in certain parts, in certain industries, till December 31st, 2021. Okay, and what is the EIDL? The EIDL defines substantial economic injury, right? Substantial economic injury is a harm that results in the inability of a small business to meet its obligations as they mature. And that's why I said assets to liabilities, right? Your ordinary current assets to current liabilities, your ordinary and necessary operating expenses. You couldn't meet it, so you had to get this item. Market, produce, or provide a product or service that was ordinarily marketed. You can't produce a new product. You can't expand. You can't provide a new service. And you say, well, why are you telling me about this? You know, because you need to hold your idle documents from approval date for 6 years. And the SBA has the ability to come back to see whether you actually are using the idle funds appropriately, okay? And, you know, you didn't use it for expansion, you didn't move, and there's a 1.5 time penalty on the balance if you were not. I mean, they are able to make that decision. You would meet with a caseworker on that area, but I wanted you to be aware of that. And of course, unlike PPP loans, idle is not forgivable, so it is a loan. A business can receive both PPP loan and a COVID-19 idle as long as the funds are not used for duplicate purposes, right? You can't use the funds for the same thing, and that's obvious. Slide 29 just talks about the expanded business areas that were eligible for these small business disaster loans. And it goes from your educational services, arts and entertainment, recreation, sporting, as we know, is very affected, transportation, motion picture industry, broadcasting, all the way down to rental, leasing, and personal and laundry services, which I found was very interesting. From September 8th to October 8th, the SBA was accepting COVID-19 idle applications for less than $500,000 in an effort to ensure the smallest businesses that were able to access the program. And again, the idle funds need to be used for your working capital, which is your current assets minus your current liabilities, your payroll, your rent, and your maintenance, your normal operating expenses. Prepayment of a business debt is allowed now, that was new, and principal and interest payments toward federal debt is also new. So you need to be aware of that. You could use that for the idle and be in compliance. Okay, so that was your COVID-related legislation. Let's go into March of 2021 under the American Rescue Plan, or what is known as ARPA. And you have the enhanced
Doreen,
credits. Yes.
Before you do that, let me hit you with a couple of questions here.
Okay.
Somebody asked about the first 10,400 unemployment.
10,200.
10,000, well, they said 200 of 2021 unemployment. Will that be tax-free?
No, I haven't seen that in the provision. I have not even seen it in Build Back Better.
Okay, and then another question dealing with the EIDL loans. Can the business close if they have a loan outstanding?
Well, you would have to prove for the Restaurant Revitalization Fund, no. The business has to be open till March 11, 2023. It's going to go over that. The idle doesn't really, I've read all the legislation on that, doesn't say about it closing, but you must use the funds appropriately. So you can't, if you close and you have funds remaining, you're going to have to return those funds, right? If you close and then get an audit and found that you haven't used the funds appropriately, you may get a penalty and owe back 1.5 times. So it depends on a case-by-case basis. But it doesn't specifically say about closure as the Restaurant Revitalization Fund does. Okay. All right, American Rescue.
I got one more.
Okay.
On a Schedule C, I'm backtracking a little. On a Schedule C regarding 179 deduction, you need not list it independently for a computer. They're just asking if that's correct. You just place the expense and list on under other.
Correct. It's not a listed property anymore.
One favor, people, please. try and put your questions in the Q&A, because sometimes in the chat they get missed, and I want to try and keep them to where Doreen's at if I can. Thank you.
Okay, so, all right, so go to your handout, slide 31 or page 31, which is the American Rescue Plan, ARPA of 2021. And that was signed into law by President Biden in March of 2021. And we know we're experiencing it right now with the advanced child tax credits. A lot of our families are receiving advances on the child tax credit starting July 15th and going all the way to December 15th. The scope of this act expanded to cover qualifying children age 17 and younger instead of 16 and younger. Okay, so that was one of the big provisions. When I was working during tax season for the 2020 returns, I had to make a judgment call on whether that client should file 2020 or go on extension because their 2020 income was too high to get the advanced credit, which they wanted. And then, of course, they had to agree to and use their 2019 return. So you were able to use the 2019 return for the advanced child tax credit. And so they were getting these credits July, August, September, going till now, middle of December. And IRS eventually created a portal where they were able to go on there and update their income. Because one of the provisions of this credit is when you go to file your 2021 return, if your income is too high, you may have to give back some of the credit. We'll go through that on another slide. But what happened is the maximum credit for the child tax credit was increased from $2,000 to $3,000. So it was an extra $1,000 for those with qualifying children 6 and over. And for those under the age of 6, it went to $3,600, which was an extra $1,600. And of course, there's phase outs, as we talked about. We're going to cover that on slide 32. There was an expansion of child and dependent care credit. That's your form 2441 called child and dependent care expenses. That's going to be covered on slide 33. Earned income tax credit was expanded, slide 35. Premium tax credit, slide 38. And then, as I talked to you earlier about the recovery rebate credit for the economic impact payment number 3, that third payment was in 2021 under the American Rescue Plan Act. And that was $1,400 for each eligible taxpayer. And they're eligible to receive and claim the difference on their recovery rebate credit. Now, in this credit, if you got more than you should have, you don't have to give it back. But there was a provision that they didn't add for the advanced child tax credit that they may fix in the Build Back Better. But for the practitioners and for the taxpayers, you're going to receive a form 1444C, like we did with the other economic impact payments. And many times the client, the taxpayer, the individual loses the 1444C. And so we don't know how much of an economic impact payment they received. And so then we have to go back to the calculator because the portal does not support providing you that information. If you have clients that didn't receive the economic impact payment, the third one, you could go to irs.gov/EIP, and there's some more information. All right, let's look a little bit more on the child tax credit that was extended, qualifying for children under the age of 18, which is of course 17 and under. As I said, the credit increased to $3,000 per child, $3,600 for under age 6, and there's new phase outs. So the first $2,000 will follow the first $2,000 of the credit will follow the phase out that we had previously, which is for married couples up to $400,000. So they'll get about 20% of the credit, okay? Now, with the additional, right, they're going to have to prove how much of a percent over that amount that they are under the new thresholds. Okay, so it creates this layer on top of a child tax credit, and it looks like it's going to be expanded, and we're going to have to reconcile it And of course, taxpayers who receive more in advance payments than they're eligible for in 21 will generally have to repay some or all the payment. I have a situation where I have a couple that's divorced. Each year they go back and forth in their divorce decree and they say, okay, on the even year, the husband's going to take the credit. On the odd year, the ex-wife is going to take the credit. And so in this year, my client took the credit in 2020, the child tax credit, and so started getting the July, August, September, October payments. The ex-spouse did not. But when that spouse files in 2021, they will be eligible to take this credit. And then my client will have to give it back. So then you have to talk to the client. Do you want to go onto the portal and adjust or ask not to get the credit? And so you have to have these conversations along the year with them, starting in July and going forward. In my case, the client had enough refund where they were able to absorb the credit if they have to give it back. So it's not a problem in their situation, and wanted the money up front to spend on the child. The child and dependent care credit was also expanded. It was increased from $3,000 per child to $8,000 per child, up to 2 children, up to $16,000. And of course, there's a phase out as well. And the credit is fully phased out when AGI reaches $438,000. That's generally your joint filer, okay? And they're going to be eligible for these credits. Now, of course, as a practitioner, for each of these credits, we're responsible for collecting the information to prove that they should be taking these credits. We have to fill out a checklist. With such an expansion, I'm thinking that by 2023, when they say the Build Back Better is going to look at 50% of new audits for those under 75,000, it's because of these credits, right? They're giving more money than the person paid out. So of course, then the taxpayer paid out. So they're going to be looking at these areas. So I find these presentations as more of an audit tactic, right? You want to go to CE and CPE so you get your arsenal in the belt and you know what you have to do when you go through an audit. And there was an increase in the maximum exclusion amount for employer-provided dependent care benefits to $10,500 for marrieds and $5,250 for married couples. So that's a pretty good increase in that as well. And so you should let your clients know about that, and individuals should take advantage of that if they have that at work. So I have another poll question for you to interact with. Put it in the chat. Can a taxpayer opt out of the advance payments of the child tax credit? Can a taxpayer opt out of the advance payments of a child tax credit?
Doreen?
Yes or no? Yes.
Doreen, while they're putting that in, one thing on the advance payment credit, did I read correctly that there is a portion that is going to be forgiven? Something about, and I was a little confused on it, if you can clarify it, that if you got overpaid, you might not have to return the whole thing.
In the advanced child tax credit?
Yeah.
That has not been passed yet. That's in the Build Back Better.
That's in the bill? Okay, so that's pending. And also the IRS is supposed to be sending out a form. I don't remember the number that tells you how much money you received on the advance payment credit. So hopefully
I think I have that in my presentation, the actual form. That's going to come out at the end of January.
Yes. Okay.
Going to give you a word, Lenny. I'm going to give you a key word now.
Okay. Do the keyword. Spell the word, please, because a couple of people didn't get it last time. Okay.
So the second keyword is advance. It's actually on this slide. Advance. 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 Okay.
Okay.
So what answers are we getting, Lenny? Is it yes or no?
I'm seeing a lot of yeses.
And so yes is correct. Yes is correct.
Yep.
You can opt out, as I told you in that case.
And while I'm in there, I have 2 more questions for you. For the employee retention credit, if a company has 2 divisions, hauling and delivering products, can it still get the EITC if sales for one division went down 80% due to COVID.
Okay, we're gonna go over the employee retention credit after this. So we'll cover that in that section. Okay?
And I think I had one more, but I gotta go find it.
Okay, let's
So go
see,
ahead.
because we have a lot to cover here. Okay,
Yes.
earned income tax credit. Thank you. Earned income tax credit. The big change with this is the ages, and that you're allowed to use your 2019 earned income. And there's going to be a box on the return to say, yes, I elect that for 2021. You had that provision in place for 2020. In addition, if you recall, you were only allowed to have investment income up to $2,500 to be eligible for the earned income credit. It has been increased to $10,000. So that's a significant increase. And the ages have been expanded for those without children. And this is under the American Rescue Plan Act, again, passed in 2021, in March 2021. And it's for temporary expansion of the childless earned income credit. And so the age is expanded for filers claiming the credit without a qualifying child. The minimum age to claim the credit was now lowered to age 19. I believe it was at 25. And for former foster youth or qualified homeless youth, the minimum age was reduced to age 18. And for specified students, the minimum age was lowered to 24. And then they removed the maximum age, right, that you had to be under age 65 without a qualifying child. So that's all been expanded. So more people are going to be eligible, more preparer due diligence, because we will have to watch out for those penalties, where we have to confirm whether they are eligible for the credit. And I had a case, if you see in slide 36, where a client, I went through the preparer due diligence checklist, asking them the questions, did you ever get denied the credit? No, no, no. And actually, I had worked on those returns, so I know they didn't get denied the credit because we didn't apply for the credit. And then in the year, of course, during the pandemic for 2020, they were eligible for the earned income credit. And so when I filed the return, I got a rejection. And then I called the client and I said, I thought you weren't denied. And they said, I haven't been. Look back, nope, wasn't denied, but they were denied in the first year, or what was the 10th year. When that first denial happened, they were with a previous preparer. And so what I ended up having to do was file a form 8862, right? Information to claim certain credits after disallowance with the tax return. And that's specific for that case, because if the client was still in, as shown in slide 37 on the bottom, the periods of denial, and there's two types. One for intentional disregard of the rules, they could get 2 years, right? It's sort of like a penalty where they can't take the earned income credit. And then up to 10 years completely due to fraud. So that was this case because the preparer had done that return, actually had been audited, and that's why they had that 10-year period. But then IRS never took it off the system for that client, for that taxpayer. And so then we had to file the form 8862. So I don't want you just to accept the fact that there is a denial, and that was the first time I had it in 25 years of practice, okay? But there is other, you don't have to file this form 8862 if the person doesn't have any qualifying children, they don't want this form, okay? So this is specifically when you have children on the return and you're getting the earned income tax credit. Now, what about the premium tax credit? In the premium tax credit, due to the pandemic and in the American Rescue Plan Act, it eliminated the limitation, as we know on our 2020 returns, where they didn't have to pay back that premium assistance, right, that they received. And it was extended now to 21 and 22, and if the household income exceeds the 400% of federal poverty level, which was the previous limitation, and the example I give you, because sometimes we don't know what that means, 400% is an example, 3 are in the household with an income of $87,840. They could go over that and still get the premium tax credit and premium tax assistance, okay? And this change is for 2021 and 2022. Had a client who was terminated August 31st, went on COBRA September and October, was able to get the premium assistance, even though their income superseded the 400%, and then started in November to pay the COBRA, Okay, so these are special rules that you need to know about. Also, and I think that's the question, Lenny, that someone was asking about the unemployment. It's not the 10,200 in 2021 that is allowed to be excluded, because that's not in the legislation right now.
Right.
But an unemployment recipient, allowing them to claim the premium tax credit. So they could get the premium tax credit even if it brings them over the threshold. And so that's form change for 8962. Okay, that brings me to poll question number 3. Put it in the chat. Put in the chat. Remember, this is not for CPE or CE. It's just for you to interact. Can someone who is claiming the earned income credit use the earned income from 2020 to calculate their 2021 credit? Yes or no? And yes, I gave you the answer here. Can someone who is claiming the earned income credit use the earned income from 2020 to calculate their 2021 credit? Right? No, you can't use 2020 for 2021. You have the option of either using 2021 or 2019. And that's why I put that there. So Lenny, at this juncture, I'm going to wait a few slides and then I'm going to do another key word, okay?
Okay.
Let's look at employment changes. So we keep going here. Here's your employee retention credit. That's what that other individual was asking about, was the employee retention credit. And the employee retention credit came under the CARES Act of 2020, which again was released and signed into law 14 days after the pandemic. That was March 27th of 2020. And then in 2021, at the end of December, we have the Appropriations Act. And so I'm going to tell you the difference between the two, okay? In the employee retention credit for the 2020 Act, it was excluding those who were taking PPP loans. All right, so if you had a PPP loan in 2020, you couldn't take the employee retention credit. Then in 2021, the Appropriations Act modified that and said for those qualified wages paid after March 12th of 2020 into 21, and as we know now, it's into the second and third quarters, you can take the employee retention credit even though you had PPP, but of course you can't use it for the same expenses, okay? So that got clarified. Then, a little bit more wordy here, I'll explain it to you. For 2020, under the CARES Act of 2020, that was available for wages paid after March 12th of 2020 and before January 1st of 21, which would mean before December 31st, 2020, okay? And what was the credit? The credit was calculated based on 50% of qualifying wages, capped at $10,000 for the 2020 calendar year. So it was 2020, $10,000 for that whole calendar year. Whereas we went into 2021, the credit calculated jumped up to 70%, right? We see that on the top there, from 50% per quarter with a cap of $10,000 for the first 2 2021 calendar quarters. Then it was extended to the third quarter. But we'll talk about that with the infrastructure bill after. So we have a 50% credit in 2020. We have a 70% credit in 2021. We have wages going back from March 12, 2020. And these laws were passed sometimes after the quarter ended, which means that you had to do a 941X, okay? A 941X. And then a new form came out on the bottom of this slide, slide 42, which was form 7200, advancing employer credits. So you didn't have to amend the 941, you actually asked for an advance, okay, after reducing your deposits. Then in 2021, advances are not available for employers that were large employers over 500. Okay, they extended it to 500 from 100. Under the Infrastructure Investment and Jobs Act, the employee retention credit then terminated the fourth quarter of 21. So you thought, well, we have all of 2020 and then we have all of 2021. But no, in November, they passed that law and they said the fourth quarter of 2021 is not available for your non-startup recovery businesses, because there are startup recovery businesses that still can take it in the fourth quarter. I'm going to have examples for you, but this is the legislation on slide 43 about the Infrastructure Investment and Jobs Act, amending the employee retention credit and doing early termination. Okay. Now, what if I already had started applying? Some taxpayers may have already submitted the Form 7200 to request an advance payment of the employee retention credit for the fourth quarter of 21. And you'll see on the bottom paragraph of this slide 43, if the Form 7200 has not been processed, the IRS will use the taxpayer's indication of whether it is a recovery startup business or not. There's an actual line on the Form 7200, Part 1, line H. Otherwise, it's going to get rejected. If an advance payment of the employee retention credit for the fourth quarter of 21 was already sent to a taxpayer that is no longer eligible to claim the employee retention credit for the fourth quarter of 21, because it is not a recovery startup business, the taxpayer will still include the advance payment on the appropriate line of the employment return. What's the employment return? Form 941, Part 1, line 13H. And then taxpayers and businesses need to keep an eye on Washington and guidance from the IRS on the fourth quarter. Okay, so you have to be aware that there's 2 years we're dealing with, two different legislations, two different amounts of credits in 2020 and 2021, and eligible employers. Slide 45, eligible employers, which before I go through that, Lenny, I'm going to give them a key word. The key word is American, for the American Rescue Plan. AMERICAN, American Rescue Plan.
Everybody got that, hopefully?
Okay. So
Doreen,
under the, go ahead.
I had two questions here for you. One is, do you know where you can get a blank worksheet to calculate the ERC, the Employee Retention Credit?
You probably go to irs.gov /coronavirus.
Okay.
And get a worksheet there under Employee Retention Credit.
And also for the Employee Retention Credit, wait 1 second. Oh, we already did that.
Okay.
Thank you.
All right, so the eligible employer was based on size and the type of employer. So you'll see in 2020, they included tax exempt orgs, excluded government entities. Then in 2021, included tax exempt orgs, included college and universities, which they didn't have in there, hospitals and medical care providers. Okay, so that's just a discussion on the types of employers. What about the government order? Because we know that we have to prove at least 50%, right, of decline, okay, in 2020. And then we have to prove at least 20% decline, right, in 2021. They made it a little bit more flexible. Or a government order stoppage. Now, a government order is an order from a city mayor, for example, requiring non-essential businesses to close. So what I always say is go onto your state site and see what's essential and what is non-essential businesses, all right? Because, for example, if you have a repair shop, that was listed as an essential business. And then we were in shelter in place. So no one could go out to the repair shop. So in essence, that repair shop was affected by the government order, but they really weren't. You couldn't use government order in the case of a repair shop. You had to show reduction of gross receipts within the thresholds to prove that they were eligible for the employee retention credit. Okay, so it's a little tricky there. And so here's the gross receipts test for 2020 and 21. And going back to the question about divisions, no, you can't do divisions. It includes all affiliates of that business, right? There could be other businesses that you have common ownership that have to be looked at in total when you're doing the employee retention credit. So that's the answer to that question. But in 2020, you had to prove a decline of at least 50% of gross receipts, comparing a 2020 calendar quarter to the same 2019 quarter, as you could see for the controlled group, right? And then any quarter after that, which gross receipts reached 80%, when you compared that quarter to the 2019 quarter, the next quarter, the employee retention credit stopped, all right? And then in 2021, again, now it got a little bit easier. We had to prove a 20% decline comparing it to the 2019 quarter. How do you define gross receipts? Well, for a for-profit business, you have total sales less returns and allowances, as shown here on slide 48, plus investment income, interest, dividends, rents, royalties, annuities, less adjusted basis and assets sold. And for your tax exempts, a little bit lower, but smaller here, total sales less returns and allowances plus investment and other income, sales proceeds, interest, dividends, rents, royalties, annuities, contributions, gifts, grants, and member dues are included in the gross receipts calculation. If you were an employer who started up during 2019, you commenced business in 2019, and you started in any of the quarters in 2019, you're going to use that quarter as the base period to determine whether it has experienced a significant decline. All right, so you have an alternative method. And then you have a startup recovery business with less than $1 million on gross receipts for the last 3 years. And you say, how could I be a startup with gross receipts calculation for the last 3 years? Because the startup could have purchased an established business and started during the pandemic. But that startup had to have at least one non-related employee. And then, of course, the Infrastructure Investment and Jobs Act in 2021 in November terminated all other employer retention credits, but not for the startup recovery business. Okay, so quickly, this is an example. I'm just going to give it to you quickly, showing a 20% decline here and an 18% decline here to look in 2021 to see whether we're eligible to get a credit at the bottom of this slide of up to 70% of qualified wages. And when this was promoted by the government, file your 7200s, file your 941s, get your money. It was for the 4 quarters of 21. So they kept saying maximum credit, get 28,000 per employee, and then the 4th quarter was taken away. Okay. Now, as I said earlier, you could have employees who may not have been working, but have allocable health plan expenses and employer retirement plan contributions that counted in the qualified wage calculation. Even COBRA payments, they tried to expand this because it was hard to get employees on the payroll. And then, however, you have to exclude other credits when you're calculating this. For example, the sick and qualified paid family leave credit and the R&D credit. Okay, those are subtracted when you're calculating these qualified credits, right? And then the wage rate is determined by looking back at the 30 days immediately preceding suspension of operations in the qualified decline gross receipt period. Okay, and the number of full-time employees is different than in the Affordable Care Act, which is 40 hours of service. Okay, this could be 30 hours of service. The average number of full-time employees determined by taking the number of FTEs and dividing it by 12 to see if you qualify. And of course, there's special rules if you started in 2019. And that's that that you see here. Also, for your startups, they could qualify for up to 50,000 per quarter credits. But again, they have to have non-related payroll. All right, so wages, of course, cannot be used for both PPP loan forgiveness and the employee retention credit. But if you applied for PPP, you could apply for the employee retention credit. And of course, forgiveness applications often include payroll costs and other expenses in excess of what is needed for loan forgiveness. That can be applied to the employee retention credit. So you could check slide 57 or handout 57 on your own. It just summarizes the credits that I talked about. And this just shows you the history of how you were claiming the credit when the credit first came out under the CARES Act in 2020. Especially for the first quarter, they were sending in a 941X because the law wasn't passed till after. Generally, the first quarter was in the middle of the first or end of the first quarter. And those were taking about 120 days to process. And then they came with the 7200 form where you were able to get the advance of the credit. And then you can also do now currently retroactive 941Xs if you determine even after this presentation that you qualify. Okay, so you can still do that. And this just is an example of your wages, right? So you have 10,000 per employee in 2021 wages in quarter one, 10,000 for employee number 1 and 2 and wages of quarter 2, no qualified health expense. And the total of 2 quarters is 20,000 each at 40,000. Okay, and here is your 70% credit, which is 14,000, 7,000 per quarter in this case. Very simple, but still a little complex. So I have another poll question, and I believe this is the last one, just to put your answers in the chat, be interactive. To claim the ERC, Employee Retention Credit, retroactively, an employer should file one Form 941X for all prior quarters for which it is claiming the credit. Should they file one Form 941X? Say you leave this presentation and you go, I didn't claim the credit. Do we just file one Form 941X? Yes or no? And what are we seeing there, Lenny? In the chat.
A mixture, mostly no's, it looks like.
Okay, because why? You have to file a 941X for each quarter. So when you amend the 941X, you then have to amend your corporate or business tax filing income tax forms to match the changed 941Xs. All right, so think hardly when you do that, but it may be worth it to get the credit. Okay, I'm going to pass through 62 and 63 because that talks about accounting for PPP loan forgiveness on your books and records. And all I want to bring out to you is here. Believe it or not, the accounting and the tax are becoming more and more married when we present our returns. You're going to see things called applicable financial statements. If you have an applicable financial statement, meaning your business gets an audited financial statement by a CPA, or you worked with a foreign government and they asked you for a financial statement, and you had to do it under international standards, that drives your tax presentation. And so this is just telling you how to extinguish your debt for PPP loan forgiveness on the books. I'll let you read that at your leisure. But you should be aware that under the Tax Cuts and Jobs Act of 2017, that you were allowed to now use the cash basis of accounting unless you were using another basis under applicable financial statement. And if your business for the last 3 years was under $26 million, that's adjusted from inflation from 2019 of 25 million, then you can use the cash basis, even if you are a contractor, okay? So it's something to look at on the tax side to possibly have tax savings for you, right? Something to visit. And of course, if you're changing your presentation, you're going to have to ask for a change under Form 3115, and that's a whole other presentation. But let's look at what the taxation impact of the PPP loan forgiveness is. We know it went through a bunch of rules and guidance during 2020, where the IRS was saying, oh, it's going to be taxable and you can't deduct the expenses that you pay with the PPP funds. Finally, it was determined that the PPP loan forgiveness was not going to be taxable and that you were able to deduct the expenses that you paid with the PPP funds, okay? And then the CAA firmly override the forgiveness legislation by saying not only that, but the pass-throughs, the subchapter S's and the partnerships could obtain basis from their loan forgiveness, okay? So if you have a loan forgiveness in a PPP, and that didn't happen in 2020, you had to keep the loan on the books, right? The PPP loan on the books, but then it happened in 2021, you're able to increase the tax basis of that PPP loan forgiveness on the books and then do your journal entry, reversing out the liability and reporting the PPP loan forgiveness amount as a M1 adjustment on your returns as a non-taxable item, right? It's a permanent non-taxable item. So very important because you want to make sure you have that basis from that loan forgiveness. And Lenny, here's that question with regards to whether I should be in business or not when I get some of these grants. As we said, for the idle, they didn't specifically say that in legislation, but you need to have used the funds, prove use of the funds. In the Restaurant Revitalization Fund legislation, if an entity cannot use all grant funds or permanently ceases operations on or before March 11, 2023, they must return the unused funds back to the U.S. Department of the Treasury. So I had a client who was starting up in 19, a restaurant, then they waited to 20, then they were in 21, this came about, they applied, they had expenses, they were expanding out, they couldn't open. They spent about $70,000, they got it, the revitalization fund, but they need to open. So then they finally opened and they have to stay open till March 11, 2023. Okay, very quickly through crypto, because I think we're starting to get towards the break in Brian's time and a Q&A. We want to leave a bit of a Q&A and I have a pretty decent amount of slides left. I'm not going to do a keyword yet, but crypto. You're going to see a lot of crypto and a lot of discussion on non-fungible token transaction. And the infrastructure bill itself, November 15th of 2021, now has legislation in the monitoring and the reporting of crypto. It actually started back in 2014, where the IRS identified crypto as an investment, as a capital gain or loss type of taxable item, a property, okay? And so non-fungible tokens, which is sort of like a digital art that's being traded, is also part of the capital gain and loss area. So I always like to look at the tax chart, not for the tax rate tables, although I get asked that a lot, is it going to bring me into the next bracket? When do you fall out of the capital gain area and when does it go up? Okay, when does it go up? So in your tax rate schedule, you will see in the up to the 10 and 12% brackets, you can have a 0% capital gains rate. But that's with the capital gains in there. Okay, so you have to keep that in mind. Then in the 22 to 24, you're at the 15% capital gains rate, and 35 to 37, 20% capital gains rate. And so crypto is calculated as that. But of course, long-term is 1 year and 1 day, short-term is 1 year or less, right? And then this is the time of tax loss harvesting, where we look at our positions, and it could be even cryptos, and we sell our losing positions, although that's a suitability issue for the client, not just a tax determination, but they can offset their gains with their losses, and then of course, an additional $3,000 against ordinary income. Now, as practitioners and as taxpayers, about 20 million taxpayers will need to consider crypto reporting on their 2021 returns. And so I bring out to you the question, have you said yes or no to the question on the front of the return? Have I received, sold, sent, exchanged, or otherwise acquired any financial interest in a virtual currency. And so and this is from the National Taxpayer Advocate, during 2020, if I purchased virtual currency with real currency and had no other virtual currency transactions during the year, then I can answer no to that question, but must answer yes if you go down to October of 2020, where they're drafting new answers, a new question for anyone who sold cryptos, received airdrops, exchanged cryptos for goods, services, and other assets, must report yes. And that's under IRS letters 6173, 6174, and 6174A. But if I just took the crypto and I held it in stablecoin and I didn't transfer it to another crypto, then no, I don't have a transaction there. So we got to get up to speed on this as practitioners, and also regarding the FinCEN and FBAR rules, okay? As you know, on your Schedule B, you have that question at any time during the year. Did my aggregate value of accounts, foreign accounts, exceed $10,000 at any point in the calendar year? Yes or no? And you must answer this even if you don't have interest to report past the $1,500. That must be submitted, because then you must file an FBAR, which is filed at the same time, the same dates, and goes on automatic extension to October if the taxpayer went on extension. But an added addition to this is if you have an unhosted wallet, FinCEN is considering these foreign accounts. And under the regulations, transactions involving counterparties with unhosted wallets or transactions involving counterparties with accounts in foreign jurisdictions are considered high risk for money laundering and for currency transaction reporting, which is known as CTR. And so when these transactions aggregate to greater than 10,000 per day, or the records alone must be kept if they aggregate to more than 3,000 per day. There is reporting requirements, okay? And in addition, if you have at any time a balance of 150,000 or more in a foreign account, with the tax return, you must file Form 8938, Statement of Specified Foreign Financial Assets. And the infrastructure bill is requiring brokers to report these crypto transactions starting in 2023, okay? So there was a question on what the definition of a broker was, and they were trying to bring the minors in, but the IRC Section 7805 interpretation will probably exclude them from that, because they got a lot of kickback from that, on that. So in addition, the Build Back Better is looking to apply the wash sale rules to cryptos under IRC Section 1091. Okay, so we have a lot going on there with cryptos. You got to get up to speed. There's going to be about 20 million clients that are going to have these questions, and you may get a few of them sprinkling into your practices. And some of the businesses and individuals that are on here may have already experienced that. Okay, so as we're winding into this, I want to bring you back to the Secure Act of 2019. Okay, just as a reminder, because that's for a lot of our financial advisor practitioners on the call. RMDs, if you turn 70 and a half in 2020, you don't have to take your RMD, required minimum distribution, till you hit 72. And under the Secure Act of 2.0, you may not have to do it till 75. We'll see what happens with that. Also, the term compensation includes any amount that is included in an individual's gross income for those that received a non-tuition fellowship and stipend. So they can contribute to IRAs, okay? They can contribute to IRAs. And our part-time workers working more than 500 but less than 1,000 hours per year can now participate in our 401ks, okay? The Act, the Secure Act of 2019, again, effective 2020, allows for new parents to qualify for a new exception to the 10% penalty if they had a child within a year and take out the retirement money within a year and be excluded from that 10% penalty, okay? And distributions cannot exceed $5,000 in that case. Usually it's 10, in that case it's 5. Also for the 529, that has been expanded for registered apprenticeship programs. And also tax-free distributions are allowed from your 529 plans to pay principal or interest on a qualified education loan for the designated beneficiary or a sibling of the designated beneficiary, up to a $10,000 lifetime limit. Okay, that one is effective for 2019. So sometimes these things go retroactive or post of the legislation. And then we talk about what is an eligible designated beneficiary. That has changed. So the stretch rules have changed, okay? So I had a client who turned 70 and a half in 2019. And they were 70 in 2018, turned 70 and a half in 2019, was able to defer their RMD to 2020. And then in 2020, the RMDs were suspended, okay? So didn't have to take the RMDs. And then in 21, the client passed away, okay? The brother, who was less than 10 years younger than that taxpayer, was permitted to be an eligible beneficiary now and use their life table. So that would say, oh, they can technically use the stretch. They use their own life table, but you can't be younger than 10 years. And that's an eligible beneficiary. A surviving spouse is an eligible beneficiary. A child of the employee that has this retirement plan or IRA owner who has not reached age of majority is an eligible beneficiary. And any other individual who is not more than 10 years younger is an eligible beneficiary. If you're not, you have 5 years, like an estate, to take those funds out. And of course, they added increased penalties in this area under section 6651A, which increased from $330 to $435. Okay. In addition, the kiddie tax law provisions were changed under the Secure Act of 2019, amending what the Tax Cuts and Jobs Act of 2017 put into place. The 17 Act said, oh, we're going to marry the kiddie tax with estates and trust rates. Then the Secure Act fixed that and said, no, we're going to do it back to the personal rates. And this change affected children under age 19, as well as full-time students under age 24. So once again, the child's will be taxed at the parents' rates after they go past their child rate, okay? And you can amend back into 2018 and 19 to take that lower rate in those years. The act is allowing that, or both, right? And then going forward, you're going to apply those provisions. And of course, the bottom of the slide talks about gifting. Gifting is permitted per recipient of up to $15,000 without having to do a gift tax return. And in 2022, it is $16,000. Okay. With regards to starting up a retirement plan, and I want to make sure we get this in here, you're allowed to get a credit. And the credit is up to, it's the first year you put in your retirement plan into place, you could get a credit up to $5,000. But of course, the credit is limited if you didn't spend that much. And the credit is 50% of your eligible startup costs, up to the greater of $500 or the lesser of $250, multiplied by the number of eligible participants in the plan, or $5,000. Now, what are eligible startup costs? Set up for administering the plan and also educating your employees, right? Because now part-time workers may contribute to the 401k plans, provided they work 500 hours or more for 3 consecutive 12-month periods. And employers are not required to match. But since we're at the end of the year, you still can open a plan, for example, a 401k, even after December 31st, up to the filing of the corporate returns or on extension. Problem is you can only do the profit sharing portion, not the employee deferral. Okay, and if the business paid the profit sharing portion in the subsequent year for the prior year, and they're on the cash basis, they can only get in that subsequent year. So that's what you got to make sure you tell your small businesses, or if a practitioner is doing the work, that they're aware of, with the financial advisor. And of course, they are promoting this to have a saver's credit, because there is a saver's credit for your 401ks, 403bs, your SEPs, and the maximum credit is $2,000 for joint filers and $1,000 for others with certain income. And I provide you the links here. And of course, another provision that the Secure Act did was allowed for pooling of plans, known as a multiple employer plan, where a bunch of even unrelated businesses could get together and pool their compliance together. And even if there's one bad apple, they won't knock out the whole plan. So that's another way to save costs. Okay, so we kind of passed the keyword, the last keyword I wanted to do, Lenny, because we're kind of getting close to where we have to take a break.
And I got a few more questions too.
All right, I think, let me just get through these last few slides and then we'll do the questions, because I don't want to take away from Brian's presentation.
Okay.
And I want to sure I cover the Build Back Better. But the next keyword is retroactively. Retroactively, like we said, you can apply retroactively the kiddie tax to 2018-19. The kiddie tax change in the Secure Act of 2019, retroactively to 18 and 19. Okay, Lenny, I'm going to hold on those questions because I kind of want to breeze through these really quickly.
Go ahead.
And then
After you're done, we'll do them.
We'll do the Q&A and we'll do the break, and then Brian could go on. Many people ask me about payroll tax deferral. Self-employeds were able to defer their SECA tax, which is known as their self-employment tax, and also employers. You have to make sure they pay 50% before December 31st, 2021 of that amount. And they should have received a letter, a notice from IRS CP 256V, and then 50% before December 31st, 2022. So that's very important. Okay. And my slide just stop sharing and we'll go back to share screen. Let's go to the payroll tax deferral. All right, we'll go. All right. This is how you repay the deferred Social Security taxes for self-employed.
Doreen, your slide's not up there.
Oh, it's not up. Okay, here we go. Could you see it now?
Yes, you're back.
To pay the self-employed, for the self-employed taxpayer to pay the deferred portion of their SE tax through that notice, CP 256V, right? They could do that through EFTPS, or they could do it through a voucher that they receive. The businesses are going to do it through EFTPS, and they should have received a notice for each quarter that they requested the deferral, all right? And you have to put it to that quarter that you took the deferral, all right? And then on slide 81 is the steps on how to repay the deferred Social Security tax here through the electronic federal tax payment system, or what is known as EFTPS, and each business should be signed up for that. This slide is the qualified business income tax deduction. Very quickly, don't forget you have that for your qualified businesses. It's a 20% deduction. It's also for real estate investment trusts or REITs dividends. There is a threshold limitation for specified service trades or businesses, like an accountant, a lawyer, a doctor who's only doing services. These are the thresholds that you see on here. But you can apply wage, W-2, and unadjusted basis immediately after acquisition, limitations to that by a calculation, okay, and still get the credit. In addition, rental real estate investors can get the credit, not your two families, because you do not issue 1099s, okay? But anything other than a triple net lease that's as a rental real estate, you should be taking the safe harbor election for small taxpayers that should be added to your tax returns annually as an election to bring you down to the 250 hours from 750 hours. of proving that you work on that rental activity, and you can hire others to that. And the rental services include advertising property for rent, collecting rent, completing repairs or maintenance on the property. And these services do not include reviewing financial statements or reports with your accountants, unfortunately. But if you hire others to do the work, you could take those hours and apply them. Okay, don't forget that QBI, and don't pick and choose QBI. You have to, those businesses that are qualified must be applied, because if you have a loss, it must be offset by the income in order to get the lowest QBI deduction versus taxable income. Okay, and the deduction is only available for any pass-through business. That's your Schedule C sole proprietor, your S Corp, your partnership, but not your C Corps. All right. Of course, I'd be amiss if I didn't tell you about, you have to be aware as practitioners and as taxpayers out there for the email scams and links, right? Your phishing links. IRS has a security summit every summer, and they want to remind you of all of the types of identity theft that's out there. This page, if you go into the hyperlink, you'll be able to read more about it. They have an updated publication 4557, Safeguarding Taxpayer Data, to help practitioners have their written security plan in place. When they click that button, they go for their PTIN. And these are the 10 steps they tell you to use when writing that security plan, right? Don't forget to use security software on your devices. Inventory, who's using them. Make sure antivirus software for computer has a feature to stop malware, and there's firewalls. Watch your phishing scams. Be up to date on those. Use strong and unique passwords for online accounts. Use multi-factor authentication. Shop at sites where the web address is HTTPS for secure. Don't shop on unsecured Wi-Fis and have your business running through unsecured Wi-Fis. There's a lot of eavesdropping going on. And make your ranges short using WP2 secure wireless encryption. Especially when you're working at home with important files and going into the network at your business, you want to have a backup either to the cloud that's encrypted, or you have a removable file that you take off premises. Backing up as often as you work. You need business continuity here for your businesses here and also for your practitioners. And a virtual private network, if you're going into the network, into the workplace, you want to do that as well. International matters. If you're doing pass-throughs or your business is a pass-through and you're working internationally, there's a new form for the pass-throughs, 1065 and 1120S's and 8865 US persons with respect to certain foreign partnerships. You need a K2 and a K3 in certain circumstances. We don't have the time to go through it, but be aware that it's out there and that you need to complete these. And if you have clients that are now going to get involved in online betting, I believe it's going to become legal, or it is already legal or forming to be, they need to report those, and there's special rulings. For example, FanDuel and similar online sites let individuals, players, buy for cash prizes, and those are considered wages, okay? Some of them are professional gamblers. They do a Schedule C, but they really can't take the net operating loss anymore. Prior legislation said you got to meet your income, gambling income, to your expenses of gambling income. Same with your Schedule A. So that has limited, and your audit technique guides. And remember what I said, when you go to a presentation, it's going to be like an audit tactic for you in late 2022 and 23 when these audits start to occur. You have to keep up with the audit guides that the IRS is releasing, right? They're known as ATGs, Audit Technique Guides. And I give you a list here of the most current ones by month in 2021. Retail industry, construction industry, non-qualified compensation plans. You even see that on the state side. Real estate property foreclosure and cancellation of debt. They're going to look at whether those forms were issued properly and whether you reported them properly on the Form 982 to exclude, and activities for not engagement in for-profit. And you know what they call that? Those are your hobby-related activities and the hobby loss rules. In addition, they're going to be looking at basis. S Corp basis. I don't have that on this presentation, but there's a new form 7203 that they're going to ask you to track from the beginning of time, the basis for your S Corp. So keep good records. If it's charitable, make sure it's a qualified publication, 78 charity, where you go to irs.gov and do that research. If it's for books and records, ordinary and necessary expenses, make sure you have the right forms in place and the right elections, because it minimizes penalties. More information on the coronavirus issues, you could go to irs.gov coronavirus. And then, of course, towards the end of this presentation, I'm not going to go through each one, but these are the changes of the forms that IRS is now starting to update for 2021. As you see, the sick leave and family leave credits, the premium tax credit, the child and dependent care expense credit, and so on. The amended filers, okay? There's amended filers that are out there because of all of this legislation. The IRS, as of November 13th, has a backlog of 2.7 million unprocessed Form 1040Xs. And that normally takes about 16 weeks to process an amended return. Now the wait time is considerably longer than 20 weeks, okay? And that's reported by the IRS National Taxpayer Advocate. Schedule 1, Schedule 2, and Schedule 3 have additional forms and lines that you're going to need to be aware of that I provided you, and new product numbers. And Lenny had a point. He gave me a call and he said, I can't get through to the IRS. I'm sitting on the practitioner priority line. Now through e-services, you can register and get transcripts as a practitioner, up to 30 transcripts per client, but you have to have a 2848, which is your power of attorney, or your 8821 tax information authorization on file. So I give you free resources through these lists in the back of the presentation, and you can look at them when you can, and very quickly, Build Back Better. Okay, we don't know if it's going to pass. It could be after the holidays, it could be in January, but they're looking to increase SALT from 10,000 to 80,000 limit. All right, be aware of that. And they could do it retroactive to 2021 if they want. So I don't know what we're going to do about that. Should we make our clients pay the state and local now, or just wait to see if this passes? And extended through 2030, and then goes back in 2031. Okay. Also, they're looking to tax higher net worth individuals. And then for your pass-throughs, they're looking to apply a 3.8 net investment income tax, even on your active businesses. So you usually were exclusive from that. That was for passive businesses. But now, if you're active and you make more than 400,000, if a single person, or more than 500,000 as a married couple on a flow through, and over 13,000 for a non-granted trust, which again goes through to your personal return, you're going to get hit with a 3.8% net investment income tax if they pass Build Back Better. Okay. And also they made permanent in the Build Back Better, if it passes, the permanent limitation of net operating loss of 250,000 for a single and $500,000 for a married couple, as well to changes to some of the international taxes, and imposing a 15% minimum tax on corporate books. So if you remember, when you reconcile your net income per books versus your tax return on your corporate returns, your balance sheet should be the book balance sheet. That difference will, under Build Back Better, will have a 15% minimum tax on it, but luckily it's for profits over $1 billion, okay? So it doesn't pull us in. On slide 107, the bottom two apply to us, okay? They're targeting cryptocurrency, including imposing rules related to common control and wash sales. Common control, a big thing, okay? My name is Doreen Inserra. This is my contact information. We're on the Q&A section. Lenny, if you have any questions while we go to take a break, I believe the break is going to come at this time.
Yes. Before we go to break, let's see if we can do these quickly. What is or was the deadline for 941Xs?
No, you could do the 941X under the employee retention credit. There's no deadline for that right now.
Okay.
And generally you have a 3-year amendment deadline. So I think it's going to apply to that. But if you find out that you are eligible for the employee retention credit and didn't take it, you're allowed to put in the 941X. But again, you have to make sure that you amend the corresponding income tax return for that business to match the 941X.
All right. Dan's asking if you purchased crypto in 21, are you saying the answer is no? If you purchase and have received, I think he's saying if you just make a purchase,
Yeah,
don't
if you
do
just make a
anything else
purchase,
with it.
it looks like the answer is still no. But the problem is, if sometimes we get a drop in an unhosted wallet, sometimes to get as a kind of a perk, then the answer is yes.
Okay. Would you
That's
say
not
the
even
safe?
done by the taxpayer. That just happens.
Would you say that if in doubt, just say yes, or you don't want to do that?
No, I mean, I would think hard about it, and I would say if I just acquired it and I didn't, and even if I moved it into stablecoin because it was dipping and I want to hold on to it, but I didn't purchase another currency, or I don't have an unhosted wallet, which they consider a foreign holding, then you should say no.
Okay. If you start an RMD but are under 75 next year, will you have to continue taking the RMDs?
If you started your RMDs already, because the Secure Act said that you were 70.5 in 2020, and then you're already in RMDs, or you previously were on RMD mode from the old act. Which act are they under? When did they start taking their RMDs?
I think they're going if the new clause in the Build Back Better passes, but are they not going to do that the same way they did prior? That if you were already 70.5 and taking an RMD, you had to continue. If you hadn't achieved the age yet, then
yeah. So you know what the threshold is, or the marking point is when what year the person turned 70.5. Okay, so if it was in 2019, they're under the old law, right? If it was in 2020, they're under the Secure Act of 2019. And then if the new legislation passes and that person's in the RMD mode, or they're not yet, and it turns to 75, then they can wait till 75.
Right. But if they've already taken it this year or prior, then they would have to continue unless they put a specific clause in there for that.
Correct.
Okay. Does the simple IRA count in those rules for the RMDs?
Yes.
Okay.
Because it's an IRA.
And somebody wants to know what the status of paper file 2020 returns are. I would probably say pray and hope.
It's going to take a very long time to process the returns.
Okay. And then I missed one going back from Larry. He wanted to know how the IRS determines what qualifies for a luxury vehicle.
It's based on a dollar amount. I see a lot, 75,000, but it's probably lower than that. I'm thinking 50,000 and above, but I could get you that definition if you want.
Okay. If I missed any questions, please forgive me. Just throw them back up in the Q&A and we will try and get to them after. Meanwhile, I think now would be a good time to take a few-minute break.
Yes.
Let's make it max 5 minutes. We are running a little bit late probably, and we don't want to cheat Brian out of time.
No,
so
if we can, if we could stay on a little bit for him, that'd be great. So you want to do like a 3-minute break? Or a 2-minute break? What do you want to do?
Let's say 3 minutes. Okay. Try and get back in 3 to 5 minutes. Okay.
Yeah, an hour is good for me. If that's where it's supposed to end at about 12, is that correct?
Yes.
Yeah, that would put you at about 10 after.
Yeah, okay. If that, I'll be done by approximately 12 or 12:10, if that's okay.
Okay.
Okay,
Yeah,
then
I'm
we
sure
can stay on.
That's not a problem. And we'll have our last pass. We'll have our last keyword.
Last keywords. Couple
with
left.
Brian, the last
Right.
two.
All right,
then
let's take that break and everybody be back at 11:10. I know it's been a lot, but we're coming down to the home stretch.
Thank you.
Okay, so Doreen,
Okay. hopefully everybody's back, and we're going to try and get through the New York State side now with Brian, and we'll take any questions with Brian's presentation as we go along or at the end, and Doreen will wrap up with any questions at the end. We don't want to keep you too long, but if need be, you can stay on a little bit after 12. We'll try and wrap everything up as quick as possible. Brian, it's all yours.
Thank you, and thank you for inviting me back again. I'm Brian Gordon. I'm from State Tax Audit Representation. What I do is I represent clients on tax audits, mostly state, residency, which I'll be talking about. I also do sales tax, and I do some IRS audits also. Somebody asked the question earlier about the Cuomo,
Cuomo grant.
the Cuomo grant. So I know it was proposed to be non-taxable. I didn't see a result on it yet, but I will look into it. And if the person that asked the question, you could see my email on the screen. If you email me, I will get back to you. Hopefully I'll have an answer soon. If I could get, if it actually passed or not, I don't know yet. The taxability part. So I'll do that, or anyone that has a question, they could email me. So today I'm going to be talking about the results of COVID on telecommuting, Nexus, and residency issues. And I'll also expand into residency issues in general. So let me start off with Nexus. So what causes Nexus in a state? I want to let you know that sales tax and corporation tax may have different results. So basically what you need to know regarding Nexus and states is that every state is different. Sales tax is different in multiple states, corp tax is different in multiple states, and they're different from each other. But there are a lot of similarities also. So let's start with sales tax. As most of you should know by now, most states have gone to economic nexus for sales tax. And why is that? That's because of the Wayfair case a couple of years ago now. But what's interesting with Wayfair regarding that case that people don't know all the details on is that they think of it as a Supreme Court decision. And although the case went to the Supreme Court, the Supreme Court didn't actually rule on the Wayfair case. What happened was that going back a few decades, all the cases regarding Nexus was determined based on physical presence. And the one that people remember, the last significant case was the Quill case, where Quill was a mail order office supply business, very large, but not like the Amazons of today. It was mail order. And so there was a case in, I forget which state it came out of. I think it was actually North Dakota. And what the Supreme Court ruled was that physical presence was required. So that became the law of the land, that physical presence was required to create nexus. So when the Wayfair case came to the Supreme Court a couple of years ago, that was the rule. So they couldn't rule on Wayfair because they would have had to say that the economic nexus wouldn't apply because that was their ruling back 3 decades ago. So what they did was they overturned their own decision on the Quill case. And they said that we were wrong back in 1990, approximately when it was. We were wrong when we ruled that that physical presence was required, because what they were trying to do is protect out-of-state businesses from having to pay tax in various states. But what they were really doing was hurting the in-state business. As you know, people really slowed down on their shopping at local stores because they were favoring the out-of-state businesses. So to make it fair for everybody, and noticing how online business was dominating the country, they said we were wrong on Quill, and it's no longer required to have physical presence. So that was really the ruling. And they did comment on the Wayfair case, though, and that was from South Dakota. And what South Dakota said was that they wanted $100,000 in sales or 200 transactions. And what the Supreme Court said was that was reasonable. It was a reasonable conclusion, but they had to send the case back to South Dakota, and Wayfair settled with South Dakota. Of course, they had to pay sales tax to South Dakota and continue collecting in the future. And based on that, the dominoes fell one by one. One state after the other started adopting similar rules as South Dakota. New York, for instance, though, and as I said, each state is different, although a lot of them do have that 100,000 or 200 transactions. New York has 500,000 and 100 transactions, not or. There's a big difference between and or. Because in South Dakota, if you have 200 transactions at $1 a piece, you don't need $100,000. That's 200 transactions at $1 a piece is $200. That's enough to create Nexus in South Dakota. In New York, $200 will not do it, because you need 500,000 in New York, at least, and 100 transactions. So the and transactions also protect people that maybe have a few valuable transactions, like, for example, an art dealer. If an art dealer sells 5 paintings for 100,000 each, they'll meet the $500,000 threshold, but they won't meet the 100 transaction threshold. So they won't have Nexus in New York. So that's the economic nexus. But don't forget physical presence. Nothing changed with regard to that. The economic nexus is only in addition to physical presence. And physical presence means basically assets or employees. So don't forget about the employees. If you have employees going to various states, you may very well be creating Nexus. And again, it's important to research every state that you are have any activity in, because it's easiest for me to just say they're all different, even though there may be a lot that are similar or they're even the same, but there's no single rule that applies to every state, because once the physical presence standard was done away with, then any reasonable economic nexus standard will hold up. So that's why you have to check every state. So for corporation tax, they also have economic nexus, but again, it's different. In New York, for instance, where we just discussed the sales tax is 500,000 threshold, and for corporation tax, it's a $1 million threshold. But also, there's a lot of little quirks or nooks and crannies when it comes to taxability in other states. So while they do publicize the $1 million threshold, that's $1 million in sales, that generally applies to sales of services, not sales of goods or tangible personal property. And that's because, and I've talked about this before, so some of you may have heard this, but it doesn't seem to stick. It's just something that maybe for some people it's just hard to understand or remember. But I'll mention it again, that it has to do with Public Law 86-272. Now, this has been in effect going way back to, I believe it's 1959. And it was put there to protect, again, to protect out-of-state companies from being taxed in other states. But it just has a protection on certain areas. And what this protects against is sale of tangible personal property when you have no physical presence. So, and what you could actually do, you could also send in, for instance, a salesman. You could send in a salesman, let's say I'll pick a state, Minnesota. You send a salesman to Minnesota, and the salesman goes there, makes a deal, and the goods are shipped from New Jersey, and there is no tax, just trying to regroup here. There's no tax on that transaction in that state if the state has tax on net income. So it's sales of tangible personal property, but only if the tax is on net income. If the tax is on gross receipts, like Ohio, for instance, there's no protection from 86-272. That's why I said it's a limited protection. So if the tax is on net income, there's no tax if you're selling tangible personal property. I hope that was clear. When it comes to service income, though, there's no protection there either. Another thing that's newer of course, in recent times, things like streaming services. Not everybody just sells widgets or other goods. There's now companies selling streaming services, so that is also not protected. For instance, Netflix. If Netflix has customers and they have sales in New York State over $1 million, and I'm sure they do, sure it's many millions of dollars, they will have Nexus in New York State, even though they may have no physical presence at all. So getting back to service income. And for service income, there's been some changes because, again, years ago, service income was always allocated to where the service was performed. In recent years, service income has been allocated based on market-based sourcing. And market-based sourcing, when it comes to sales of goods, is generally simply where the customer is located. The interesting definition under market-based sourcing for services is where the benefit of the service is received. And I'll give you an example of that. A service I like to talk about is a computer technician. And I'm sure, I would imagine all of you must have had the experience where you had a problem with your computer and you had to call some type of technician that would get into your computer and get access to your computer. You see the mouse flying around the screen because somebody else has control of it. Now, where is that person? So let's say you're located in Staten Island, and that person that you called is located in New Jersey. So they're providing a service for you. So where is that service, the sale of that service allocated to? Well, under market-based sourcing, that's going to be allocated to New York because you are receiving the benefit of the service in New York. He or she is performing the service in New Jersey, but that doesn't matter. So again, based on New York's rule of $1 million threshold, that if those sales in New York are over $1 million, that person or business will have Nexus in New York and have to have a filing requirement. Okay, so now I want to talk about telecommuting. As I said in the previous screen, employees cause Nexus. So what about telecommuters? Well, that's an employee in a state. And in most states, the answer is yes, that telecommuters would create Nexus in that state. So if you have a business in New York and the employee is telecommuting from their home in New Jersey, that is going to create Nexus for that company. For the New York company, they're going to have Nexus in New Jersey because they have a telecommuter in New Jersey. And this applies to corporation tax or sales tax. And this is still, relatively new, and it's been evolving. And that's why, I don't know if you're aware, the Bloomberg company does an annual survey of state tax departments. And they do that because there's a lot of gray areas. So they just go right to the heads of the departments or people that will answer these types of questions. And they said, would you tax a company for having a telecommuter in your state? So 36 out of the 50 states said that anywhere from 1 to 6 employees performing non-solicitation activities would create Nexus in their state. The reason they said non-solicitation activities is because solicitation activities was one activity that would always create Nexus. New York has that, most states have that. So they always said that if you send a salesman into my state for sales tax purposes, we talked about Public Law 86-272, that wouldn't necessarily do it for corporation tax. But for sales tax, if you send a salesman into a state, that would create Nexus. So then the next step was, well, what about telecommuters? And for a long time, they weren't sure, or most states would say no, but now most of them are saying yes. And that's probably, I think it has something to do with Wayfair, that states are getting stronger and they're having their way more, and they feel that should create Nexus, and that's what they're asking for at this time. So again, they said, well, what about back office activities? And 33 states also said yes. So has this been tested? The telecommuting question, has this been tested? And again, yes, it has been tested. And by our neighbor, the state of New Jersey. There was a case called Telebrite. It's been a while already. I'd say it's about 15 years. I don't remember the exact year, but this was a Maryland company. Telebrite was a Maryland company, and they had one employee that happened to move to New Jersey, and they were a valued employee, and they worked, I guess a simple term, I'll call them a computer programmer. I don't know exactly what that function was, but they worked from their home in New Jersey on their computer, and New Jersey got wind of that, and they decided to tax Telebrite as a New Jersey company. And Telebrite took it through the New Jersey courts to the highest court in New Jersey, and Telebrite lost. So this is clearly New Jersey's position. It's held up in the courts, and it was one employee, and that created Nexus.
Brian,
Yes.
sorry to interrupt.
Okay.
I'm doing the next key word.
Okay.
And the word is, Lenny, are you there? The word is audit.
I'm here.
Audit. AUDIT.
Please get that down. I know a couple people missed the word already, so there is a one-word leeway here. The
Audit.
word is audit, the one thing that none of us want to hear.
So, Brian, while they're writing that down, there's a couple of questions
Okay,
from Larry Kessler. And he says, first, do New York accountants who have California clients, the accountant never goes to California? At what point does New York accountant have to report California income on accountant's return?
okay, good. Good question. I used the example of the computer technician, but it actually applies to accountants also. However, it applies this rule, and again, every state is different. And I'm glad to have this little interaction. It makes me feel more comfortable that I'm actually talking to people rather than just looking at a screen. So the answer would be yes, if your business is a corporation or an S corporation, because these are corporation rules. So you're using the market-based sourcing, so you're paying attention. And you have a customer in California where the benefit of the service is received in California because you're doing his taxes. He's in California, so he's getting the benefit in California. So if you're an S corporation or a C corporation, then that's how that should be allocated. Well, actually, California's rules, again, California's rules are different from New York rules. New York has that for corporations. California has that for any type of entity, which would include partnerships or sole proprietors. So California's rule and their threshold is, it started when the rule went into effect several years ago at 500,000. Now there's a cost of living increase. I think it's up to roughly, I'll say 560,000, just to pick out a number. I don't think it's 600,000 yet. So you would have to have, and I'm guessing that maybe you don't have 560,000 in revenue from California sources. So if you do have over 560,000, then you would have Nexus in California, and you would have to file California returns.
So, Brian,
yeah.
what you're saying then basically, and this I would even include sole proprietors. If you're a corp, an S corp, or even I guess a partnership, or a sole proprietor, unless you do a lot of returns and have a lot of income coming out of the various states, more than likely you're not going to have to report in a different state other than New York if you're in New York.
That's true, because they have fairly high thresholds, and that applies. Just, again, questions are good because if you're a small internet business, you're not an Amazon, you're not going to have Nexus. I was referring to like internet sales. You're not going to have Nexus in 50 states like Amazon does, because you would have to sell, like in South Dakota, at least 100,000, and that's generally the minimum threshold.
Yeah.
And that's why the Supreme Court liked it, because it didn't pull in every small business. So you have to have over the threshold. And again, you have to do the research to check the threshold for sales tax, corporation tax, income tax in every state that you think that you might have a liability to. But the good news is, and this is really part of the same question that was just asked, on the market-based sourcing in New York, you're a New York preparer. Again, if you're an S corp, you could allocate out, which reduces your New York allocation. So just to come up with an example, and again, this was spurred by the question. you could have 20% of your revenue, you know, say if you do a sales factor, 20% of your revenue outside of New York, but you don't have to report anything to any other states because you're under the threshold. That's an interesting thing to think about. So when it comes to allocation, you know, that's another thing I came across, you know, through my travels, that people don't understand that when you add up all the states that you allocate to, that you actually pay tax in, it's not necessarily 100%. You don't necessarily have, you know, 50% New York and 10% New Jersey and 10% in Pennsylvania, et cetera, add up to 50%. You could have under 100% or you could have over 100% because of the state's rules. Okay, so I'll just leave it at that unless there's another question with regard to that. Okay, so I was, you know, building a little foundation for the next slide, which is my COVID-19 slide, because, you know, we were talking about telecommuting in general and people causing Nexus, but what if somebody was telecommuting only because of the pandemic? Let's say you have an employee that lives in New Jersey, never telecommuted before. So let's say in that Telebrite example I gave before, that employee created Nexus because they were telecommuting. But what if they weren't? They never did that. But during the pandemic, they started doing that. And the pandemic in New Jersey and these states I list here, they all had pandemic-related policies, which said that if you are telecommuting in our state, and this is what, and so it started, I forget the start date, I think it was about maybe March of 2020 was the start date. So if you were telecommuting in our state only because of the pandemic emergency and you were directed to work from home, the state of New Jersey and several of these other states said you will not create Nexus. You will not create Nexus because of telecommuting due to the pandemic. Not only will you not create Nexus for corporation tax, you won't create Nexus for sales tax, and you won't create Nexus for the employee themselves, withholding tax. You won't have to withhold. They're not going to tax the individual on New Jersey income tax because you're just there for the pandemic, because of the pandemic. And that had an end date. I think they all ended. I don't know the dates on all of them, but for New Jersey, it ended October 1st of this year. So if that telecommuting employee that was telecommuting only because of the pandemic and not creating Nexus and not creating any taxable situations, if they continue to telecommute, because I'm sure you've seen a lot of businesses and a lot of people have felt like, you know, it's really not a bad way to do business. It's not, you may disagree, I may disagree, but some people in some positions may be just as productive or more productive telecommuting from home. So if this employee that we're talking about, in agreement with the owners of the corporation, say, you know, you could continue telecommuting from home. It's not affecting us negatively at all, and in fact, it's a positive result. You're more productive. We like it. So after October 1st of this year, 2021, that employee now that got an exemption is now creating Nexus for that corporation, and again, sales tax nexus, depending on what kind of business it is, and they're creating a situation for themselves where they will have to, you might call it individual nexus. They'll have a reporting requirement. Well, as they would anyway if they're a resident, but they're there. So there is the, let's say, the grace period during the pandemic, but if you continue, then you will create nexus. And the same thing applies. There's 17 states listed there, but New Jersey is our neighbor. And I'm focusing on that one. So what's interesting, though, is that what New Jersey is saying, that an employee will create nexus and you'll have to withhold for that employee. But what about if they work for a New York State company? What has New York State done with regard to the pandemic and the emergency situation? And the answer is nothing. New York had no new policies. Some were proposed, but they did not pass. And New York has been very strict as far as anyone telecommuting in their state, they felt created nexus. There was no policy changes. And what's probably their most consistent rule that causes problems is what's referred to as the convenience rule. And that's always been in effect. And New York is really the leader. And I think the primary state with that rule. I think there's 4 other states in the country that have it. Most don't. Almost all other states don't have it. And what the convenience rule says is that if you're telecommuting out of state, it's still New York source income. They feel that if you're working for a New York company, you're working in the office, it's New York source income. If you're telecommuting from home in New York, it's New York source income. If you're telecommuting from home in Connecticut, it's still New York source income. They feel that it shouldn't vary, and that's always been their position. It's a very difficult rule to overcome. And as a matter of fact, they claim they came out with a statement during the pandemic to reinforce that their convenience rule is still in effect. So if you work for a New York company, you're working at home in New Jersey, that's New York source income. So that contradicts what I just said before, because New Jersey is saying that that's New Jersey source income. But if you live in New Jersey, it really doesn't matter because there's going to be New York withholding on that. And in New Jersey, you're going to take the resident credit. So New York's rule has been hard and fast. And even if, they say the convenience rule, the reason that they use that word, the convenience rule, is because they're saying it's for the convenience of the employee. Now, they could work in the office, but whose convenience is it for to work from home? It's the employee's convenience. So they're going to work from home for their convenience. It's still New York source income. Now, that convenience part of the rule has been stretched, for instance, during the pandemic, to the point where it's not for the employee's convenience. But even so, they're saying that that in some way it is, and that rule continues. Also, during the pandemic, I see my time is going fleeting fast, so I'm going to stop moving along.
So Brian, I don't want to interrupt you. I just want to do this next question, because the next keyword, because we have 2 more.
Yeah, okay.
This one and that one.
Okay.
This one is license. LICENSE, license.
Okay, thank you.
All right, and there's a couple of questions, but I guess we'll
Yeah.
have to see if we can answer them at the end. to you,
Okay.
questions to you.
Okay.
Okay?
Well, let me know them now. Maybe I'll do them quickly.
Well, they're kind of, all right, if, it never crossed my mind that if I prepare tax returns for out-of-state taxpayers, that I may have to file it in those states. So if I allocate outside of New York, I don't have to show that I filed returns in those states. Wouldn't that set me up for audit? And
Okay,
then
well,
one,
no, yeah, okay, go
Okay.
ahead.
and then one more is I have New York and S Corp, and I recently moved to California. Continuing working for New York contractor, do I have to pay California corporate taxes?
Yeah, I'll do the first one. The first one, yeah, like I said, there's a benefit that if you're allocating out, I think you're taking advantage of that. That's a good thing. And you're only taxable in the other state if you're over the threshold, which in California is 500,000. Most of the corporate thresholds or income tax thresholds are 200,000-300,000. So you might not reach that threshold, but yes, if you are over the threshold, then yes, that's a thing. That's the thing, because everyone's taking advantage of that market-based sourcing. Every state is trying to pull in money from non-residents. So, so what might happen for some companies anyway is that they'll pay less to their own state, but they'll start paying more to other states where maybe it'll balance out. But yes, so what was the other question? I like to get questions.
Oh,
About California?
the New York S Corp
Yeah.
recently moved to California. They have a New York S Corp continuing working for New York contractor. Do I have to pay California corporate taxes?
So, yeah, well, without knowing everything about it, if they're sitting in California, then probably yes, that's physical presence, forgetting about thresholds or anything like that.
And they have to ask for authority, I would think.
Yeah, you register with California. If you're
Okay.
sitting there working there, yeah.
All right.
So just quickly, in Massachusetts, during the pandemic, they didn't want to lose the tax base. So if someone was working for a Massachusetts company and then they said they have New Hampshire employees across the border, now those New Hampshire employees don't want to pay Massachusetts tax. But Massachusetts said we're gonna use the convenience rule like New York does during the pandemic, and New Hampshire didn't like that because New Hampshire's a very anti-tax state, and the governor said you're not gonna tax my people when they're working in New Hampshire. But Massachusetts said yes, we are. New Hampshire took it to the Supreme Court, and their Supreme Court refused to hear the case. So I feel effectively they were upholding the convenience rule. Like, don't bother me. The convenience rule is a law. It has basis. Most states don't use it, but so I feel that strengthens New York's position because the convenience rule, they've always had it, and they're going to continue to use it. Just a little bit more on the convenience rule, since it is so annoying, to be perfectly honest. And New York won an important case on the convenience rule in, I think it was 2005, where the employee was working from Kentucky. So they were almost embarrassed to win that case, but it's not so hard to understand in modern times when people are working from home with computers. Why does it matter if you're in New Jersey or Kentucky or Texas or Florida, wherever? So so they made some allowances where you could, if I could use the term, beat the convenience rule. But in short, what you really have to establish is that there's a need to be in Kentucky. Not just because that's where your home is, but let's say the business has something to do with horses, where there's a lot of horse breeders in Kentucky. Not that I know a lot about it, but there's a lot of horse breeders down there. So if you're a horse in the horse business and you need to be in Kentucky, so then you're not simply just telecommuting from home. There's a reason to be there. So that's the only allowance that what they made really, and they listed factors, but you know, so that's the primary factor. If you're near specialized facilities, there's secondary factors where if you meet 4 of the 6 secondary factors, one that I highlighted there, if you're reimbursed for expenses for your home office, if you're required to be there, so that's not, again, not convenience, you're required to be there by the employer. So things of that nature. So there is a slight way around it, but if you're a typical telecommuter, still applies. If you're just working from home because that's where you want to work, or even in the pandemic, where you could certainly argue that it's not convenience, but New York still feels that it is. Okay, so let me get into a little bit more into residency, because also COVID affected residency. And residency is important because a resident pays tax on all of their income, where a non-resident pays tax only on the New York source income. So there are 2 ways you could be a resident. And this is important because to me, I deal with this all the time. I realize that other people don't. So they get confused between the 2 ways to be considered a resident, which is being domiciled or a statutory resident. Because too many times I hear that, for instance, someone says, well, especially down in Florida, I have to make sure I'm not in New York for 183 days. And then I'm clear. But no, that's not it at all. That's the day count for statutory residents. But that rule says if you're in New York for 183 days, it doesn't say anything about being out of New York. And if you're domiciled in New York, which basically means that's your home, your primary home, your permanent home, where you've always been, and you've been there for a very long time, which most people understand that, it's where you live. In order to change domicile, you're not just going to count the days and say, well, I wasn't in New York for 183 days. I didn't meet the statutory resident test. So I say, okay, so how many days were you in New York? I was in New York 180 days. Okay, well, how many days were you in Florida? Well, 150. And so what about the other 30 some odd? I was on vacation. Okay. So you're in New York 180 days, you're in Florida 150 days, and you're going to convince the New York State auditors that you changed your domicile, your permanent home, to Florida when you're still spending more time in New York, the place you've lived your whole life. That there's no way that's going to fly. Now during COVID, I felt that this was a great example to really show domicile, because people would come to me and say, for instance, here's the example. Let's say they're a New York City resident. They have a nice apartment there. They work there. That's where they live. They lived there for 20 years. And in 2021 or 2020, whatever it is, they went to the Hamptons. They're home in the Hamptons. And they spent the whole year there. And they say, I'm not a New York City resident, am I? I'm going to file as a non-resident. I didn't spend one day in New York City in 2021. Well, what's going to happen at the end of the pandemic? Are you going to go back to the city? What was your plan? Your domicile stays the same until you make a definite plan, a decision to move somewhere else permanently. It's not a day count issue when you're talking about domicile. So you could go from New York City and live in the Hamptons for a year. You're still domiciled in New York City. That's a very important aspect of this COVID situation that people have to understand. And a lot of clients get very disappointed to hear that. Unless if they really made a permanent move, then fine. I made a decision in March of 20, I'm out of here. and I'm not coming back. You don't have to sell your place, but really don't come back. And the auditors will see in, let's say, 2023, when they audit you, did you move back? And if you didn't, and you maintain your position that this was a permanent move, then you could win that case. But if you do come back, say a year later, you're not going to get a break off for 1 year for New York City tax because you didn't change your domicile. You're still domiciled there. Okay, so this slide talks about intent, as I just mentioned. So move to a couple of things I want to cover. As I said, the domicile continues until a new one is established. And the burden is on the party making the change. So again, here's the factors. It's not just the day count. They're going to compare the two homes that they're interested in. Of course, the day count is important. But I listed two cases there, Cook and Patrick, where they won on a change of domicile when they still spent more time in the city. They were city cases because of the other factors. They were both really family connections. I'll give you a simple example, not as far as these cases, but I've had a case recently. This family that my client was a family, say mother, father, 2 kids, and they moved to Florida. But the father, the husband, still was a professor at NYU. So he basically commuted. And he has the summers off, so he's in Florida. Long weekends, so he'd go back almost every weekend to Florida. He's commuting to New York for work. So even though he may have over about 100, let me see, how many days did he have? So he had under 184 days, but because he did have a place there, but he spent more time in New York than he did in Florida because he worked there. But he wasn't domiciled in New York because his family was in Florida, and I think you could understand that. The kids go to school in Florida, they do everything in Florida. Sure, they come up once in a while too, but the center of their life is in Florida. The family, where the kids go to school, is very important. That's their home. They have an apartment in New York, but that doesn't create domicile. This talks about habit of life. That's basically what I just talked about. Is where
Brian?
I picked the yeah.
Brian?
Yes.
So I think we could stay on for 10 more minutes if that's okay with everyone, so we could get your presentation in because it's very important with the COVID stuff.
Yeah.
That's the prior key word that I see highlighted there.
Yeah, I highlighted it because we picked it as a keyword. Yeah.
Okay, there you go. You got a prior keyword license, and here's the last, that extra word that you may need, because you need 6 out of 7, and that's apartment. Where's your apartment?
Yeah, I'll catch up to that in a minute where I highlighted that.
And he'll get to it, okay?
Yeah,
apartment.
Yeah.
All righty. And we're going to stay on 10 more minutes if that's good. Is that a good amount of time?
Yeah, now I realize I need it. So,
okay. Thank you.
Yeah. The reason I highlighted this is because I always hear about, again, some practitioners, they have a checklist. Okay, you moved to Florida. Did you get the driver's license? Did you do the voting registration and other checklist items? I don't have a checklist item. I don't have a checklist. You have to move. You have to bring your family down there. You have to have your lifestyle down there. You also do need the license and registration. I mean, it's very helpful. I definitely recommend doing that very strongly. But if you are down there 11 months of the year and you say, well, I forgot to change my license, it's not going to matter. You're there 11 months of the year. It's the people that change the driver's license and the voting registration, and they're in New York 11 months of the year. That's not going to do anything for you. It's the primary factors that matter. It's not just days, it's not the driver's license, and it's not the voting registration. You have to change your lifestyle down to Florida. Okay, this is a lot of records. I think everybody knows that these residency audits are very voluminous. Now, this is interesting, that some quirky things that people don't know about, that you could be domiciled in New York, but not taxed as a resident. And as an example, this is the 30-day rule. Let's say this might pertain to more of a younger person. They have an apartment in New York, they have a job in New York, and they get a temporary transfer to California. Just they want them to set up a new office in California, or train somebody out there, or something, a temporary assignment in California. So instead of paying their rent in New York, they give up their lease. So now they don't even have a place in New York. But they're still domiciled because, as I said, your domicile stays the same until you establish a new one somewhere else. Now, in this example, did they establish a new domicile in California? No, because he's coming back in a year. That's not a domicile. Okay, so there's no permanent place of abode in New York. They rent an apartment in California for the year. And now here's the key, why it's a 30-day rule. In that situation, if he comes back to New York, maybe during the summer for 30 days, then they're going to be taxed as a resident. But if they don't come back to New York for 30 days or less than 30 days, they're not going to be taxed as a resident, even though they're domiciled in New York. And so I use the example that their anchor is in New York. Imagine like a 1,000-pound anchor planted in your front yard. It stays there. Just because you go temporarily somewhere else, the anchor is still in New York. There's also a 548-day rule. And again, this is for someone that's domiciled in New York. So if you're domiciled in New York, you go to a foreign country for a year and a half, that's 548 days, about a year and a half, then you don't have to pay tax in New York as a resident. Even though you're coming back, you're domiciled in New York, you go for it, again, temporarily. You go there for a year and a half. You don't have to file as a resident. And as that continues, you go to 2 years, 2.5 years. There's a ratio of 90, you're allowed 90 days back in New York during that period of the year and a half. So that ratio of 90 days to 548 continues as it goes on. Okay, I just want people to be aware of that. So the other side of the coin, statutory resident, and I have 5 minutes for that. And that's, again, completely separate from domicile, because this is primarily for someone that's domiciled somewhere else. So someone else that maybe they're from Connecticut, they're domiciled in Connecticut, they have a house in the Hamptons. So the domicile, although the domicile somewhere else was eliminated after 2018, but it still applies to most people. So you have a place in New York, and if you're here more than 183 days, you're a resident. That doesn't mean you're domiciled. It means you're a resident for tax purposes. Certain things that I want you to know regarding that is that the rule is 183 days, but you have to have a permanent place of abode for substantially all of the year. So if this Connecticut person buys a house in the Hamptons, let's say before the summer, they buy the house in the Hamptons in May of 2021, and they spend more than 183 days there for the remainder of the year, they're not a resident because they didn't have the place for 11 months. The next year, if they're there for 183, more than 183 days, they will be a resident. So your first year or your last year, if it's a partial year, you're not going to be a statutory resident because you don't have it for substantially the whole year. This also comes into play if there's a major renovation. So that could interrupt your availability to have a place. Or let's say you buy the place in January, but you don't move in until May because you're renovating it. So you don't have it for substantially the whole year. So there's some little known rules that could benefit you. Other things I've come across is it doesn't matter if you, usually it's an apartment in New York we're talking about. Doesn't matter if you own it, you rent it, or even if you're a permanent guest. You don't have to be on the lease, you don't have to be on the deed. If you live there, then then that's a permanent place of abode, and you could be a statutory resident. So what does that mean if you live there? Basically, you have a key and you have unrestricted use. It could be your friend's apartment or your friend is on the lease. But if you have the place, you have the key, you come and go, you keep your personal items there, then that's your place. You have a place and you're going to be a resident. A rented room doesn't count. I had a case like this year. It was very interesting, and because the CPA that referred it to me wasn't aware of this. A person was renting a room in someone else's apartment, actually, and he was going to report him as a resident, but it doesn't qualify because he doesn't have his own kitchen, for one. I guess that's basically it. It was the kitchen, and there was a kitchen in the house, but he didn't have free use of it. It's let's say it was a friend, but basically it has to be a whole apartment. You need heat, hot water, you need a kitchen. Renting a room doesn't count. So there's some little known things that are important. This was the keyword audit. So here's another thing, because some people were picking up, if someone has a, their name, let's say like people ask me a lot this also, I bought an apartment for my son. Am I going to get in, they're going to hold me as a resident? Well, if you present it properly, no, you're not going to be held as a resident, because what is your relationship to the dwelling? Your relationship is landlord. It's not resident. It's used primarily by somebody else. In this case, his son. So if it's used primarily by somebody else, and you have to, even if you did ever go there, you're ringing the bell, you're asking, can I visit you? It's not, it's not your place. So if it's not your place, they can't hold you as a resident. Also want to mention exemption for students, undergraduate students. Let's say at NYU, you're not going to be held to be a resident. So there's that exemption. So the important exemptions for statutory resident is you only had the place for part of the year. On the day count, I'll just jump ahead because I want to wrap this up. Partial days count as a day, but what doesn't count, so if you come into the city for an hour, that day counts. But if you're just passing through the city, let's say on the way to the airport or the way to Connecticut, that doesn't count. If you're in the hospital in New York City and you're an inpatient in a hospital, those days don't count. But the passing through is very important that some people aren't aware of. Corporate apartment is my apartment. Corporate apartment is a double-edged sword. If it's a corporate apartment, it's not your apartment, then it's not a residence. But what the auditors will look at is just because the corporation owns it, that doesn't mean it can't be yours, because like I said, if you have the key and you go there whenever you want, you're using it as a resident, as your home, they're going to pick you up with the corporate apartment. A true corporate apartment is one where the corporation owns or leases the apartment. Generally, there's going to be a custodian of the apartment where they keep a log of what clients go there, and when they use it, and if the shareholder of the corporation wants to use it, they have to get online just like everybody else. Oh, you want to use it Thursday? Sorry, the chairman of IBM is going to be there. You can't use it. And in that case, it's not his residence. And then he wouldn't be a resident. So you have to, again, keep proper records on that. So just one last one. This was the Mays case. Remember I said you have to have the place for substantially the entire year, 11 months plus? Well, this Ms. Mays had 2 apartments. She had one from middle of January till May, and then from May till December. And she said, well, that's not permanent. Well, according to New York's law, that's a permanent place of abode. They connect up. You had a place to live in New York for substantially the entire year. So she lost her case. So that's my presentation. And again, here's my contact information. Any questions? We can do that now.
Thank you, Brian. I see one question I think we didn't cover. It's from Nick Wastella, and it says, example, at the end of 21, live in New Jersey where you rent an apartment. As of 1/1/22, buy a home in New York State where you intend to live. It needed renovations until 6/30/22, so you stayed in New Jersey apartment. Then you moved in New York 7/1/22. What was the residency for 1/1/22 to 6/30/22? So you lived in New Jersey at the end of 21 where you had an apartment. Then you buy a home at the beginning of 22 in New York. Renovate it, don't move in until.
Yeah, so he must still have the place in New Jersey that he's living in while the New York place is being renovated. So he never has to get rid of the New Jersey home. It's always clearer when you do that, but you don't have to. So as I said, renovation, you're not living there yet. So my other question is this going to be a permanent move to a new domicile in New York? If that's the case, then if he's leaving New Jersey behind, even if he keeps the apartment there or whatever, then his residency would change in July of 22 when he really moves in.
That's what I thought.
If you're talking about just statutory, here's a tricky one. Let's say the house is in the Hamptons and he's not going to use it. His main home is still going to be in New Jersey. If his main home is still going to be in New Jersey, then he has no residence in New York for 22 because it's just a partial year. So you have that. If it's a permanent move, he's planning on changing his domicile, then he did that. He couldn't have done that in July. But if this is just a second, if New York is the second home, then regardless of the days he spends in 22, he's not a resident in New York because he didn't have the place for the entire year. It was under renovation.
Okay, I have one more that we could fit in here. If someone gets a sublet apartment in New York for a month for work, does New York see that person as a non-resident for that month? If someone gets a sublet apartment in New York.
Yeah. So they're a non-resident in general terms. So the only thing that could change that is getting the apartment for the month, and that would not change it because you have to have the apartment for 11 months and a day. And although that's not a hard and fast rule, but generally that's the guidelines in New York. You have to have a place for 11 months and a day.
Okay, and Larry Kessler had questions for you. He will talk to you about them. They're kind of detailed.
Okay. Yeah, you could
Right.
email me or try to call me sometime, but we could set up a call.
All right. So I think we're
Okay.
at the end of this presentation. And we covered a lot of information. And I want to thank Brian very much for doing this because the telecommuting, the residency issues, like you said, with New Jersey, they're starting October 1st with decoupling from allowing New York City headquarters. So in other words, if someone just decides to stay in New Jersey because they can and telecommute and not go in the office, there may be a problem with the New Jersey credit. I don't know. So this is all very important stuff and you need to talk to Brian about it.
Okay, well,
Okay.
thank you for having me. I always enjoy it.
We'll do it every year.
I just want to wrap up a couple of things, Doreen. Number
Yes.
one, thank everybody for being online. Thank Brian and Doreen for their excellent presentations and handouts. If we did not get to any questions, please get to one of us and we'll try and get them answered for you. Hopefully we got everything. Reminder, we are doing, as I said, one more webinar with Jack Gold and Warren Bergstein, going to do an annual update. By that time, hopefully we have our last tax law, but who knows the way things are going. Brian, if you could get me the information on the PTET, I would appreciate it if you got somebody that might do that. And I'm going to reach out to people and see, because I've had a couple inquiries about that. And if we get enough people, maybe we'll try and set something up. It's going to be real tough late because we're approaching the holidays in the beginning of January, but we'll see if we can squeeze something in somewhere. With
Okay,
that,
yeah, I have a person that, he's definitely prepared. The question would be, does he want to do it? But I'll give you his contact information.
appreciate it. With that, I'm going to thank John and Marie and Bart and everybody over at SCORE again for allowing us to collaborate and work with them. I think it's been a great relationship and we hope to continue it going forward. Obviously, we hope to do it next year in person again. So let's pray that works out. And with that, basically, I want to wish everybody a happy holiday, Merry Christmas, Happy New Year. And thank you again for coming today. And most of all, everybody stay well and have a good tax season.
Happy holidays. Stay safe.